and Sri Advocate Vaitheeswaran for today's topic is controversies in input tax credit. The new year 2022 is going to bring a significant changes in the manner of availing input tax credit by the taxpayers under the Goods and Services Tax Act. The additional condition to avail ITC by the recipient of the goods services introduced by the Finance Act 2021 has been made effective from January 1st, 2022. With the upcoming changes, ITC on an invoice of the debit notes can be availed by the recipient only when the details of such invoice debit note have been furnished by the taxpayer in his outward supplies GSTR1, and such details have been communicated to the recipient of such invoice in form number GSTR2B. Basically, the buyer will not get credit for the tax paid if the supplier does not upload the invoice and file returns on the GST portal in a timely manner. Henceforth, the taxpayer will not get the benefit of availing 5% provisional ITC as allowed under aforesaid rule. Our advocate K Vaitheeswaran is with us. He will share his views in details to enrich our knowledge. Thank you. Now I request
Thank you, sir.
Sandeepji Chordia to say something.
Sandeep Bhaiya.
Thank you, President, and warm welcome to our speaker. Good evening to our President as well as all the attendees in this conference. I think that to say something about Vaitheeswaran is, I don't think I'm the right person. So, in a short, it is a very interesting issue that is related to controversies in ITC. ITC was a very important limb at the time of introduction of GST, but during the course of this time, from 17 to 21, 22, there should have been a seamless flow of credit. But somehow the government is tinkling with this segment of the law regularly. In fact, 16(2)AA was introduced. There was some rider that 5% mismatch would be allowed from thereafter from 1st of January 22. That has also been abolished. Thereafter, God knows what will happen to 16(4). We are awaiting that issue, which is very critical. Thereafter, the reason for disallowing credit for which the payment has not been made for more than 180 days. Thereafter, lots of cases are coming to the advocates as well as chartered accountants as regards to mismatch between 2A and 3B. Blocking of ITC is very crucial. It is very crucial factor which is hurting the seamless flow. Circular trading, fake invoices. Thereafter, erroneous interest on erroneous statement which has been filed. This is an important aspect. And thereafter, last of all, sir, what is very important, that the case laws as regards to what after AAP and company, what will be the fate of they are. In fact, the dealer are not that much concerned. Rather, we advocates and chartered accountants are more concerned about this ITC. So, what will be the fate about AAP and company? And as regards to the recent judgment of LGW passed by the Calcutta High Court, there definitely were many judgments previously also covering this. It is nothing new in this. With this, I'll pass on to Mr. Mahendra Agarwal to say something about the learned speaker and then continue with this session.
Thank you, Sandeep Bhai. One of the major rigors of the amendment, as Kamal sir has said, is that it will increase the dependency of the recipient on their supplier for availing any ITC on their supplies. With such drastic provision will brought in the GST, it is imperative for the businessmen to safeguard themselves by introducing such stringent and unwavering clause in their vendor agreement, so that they can safeguard their ITC credit by including any such clause in their vendor agreement so that do not lose any ITC due to the just introduction of the new clause with from 1st January. Further, it won't be improper to state that having such restriction provision run absolutely contrary to the intention behind the introduction of the GST regime, which was to eliminate the cascading impact of the under the existing regime and to allow free movement of the tax credit. There is no denied that government must combat bogus invoicing, but while doing so, it should not harass the bona fide businessman to avail them the credit. Now, with the permission of the chairman, I will read the profile of our learned speaker today, though we know he do not need any introduction, but as a matter of custom, I have to. Advocate K Vaitheeswaran has over 29 years of experience in the field of law, advising various corporates both in India and abroad, as well as advising various associations. He holds additional qualification from Institute of Cost and Work Accountants of India and Institute of Company Secretary of India. He is also author of various books of indirect taxes, SENVET and VAT. He is also the head of Taxation Committee of Madras Chamber of Commerce and Industry, member of Tamil Nadu Branch Committee, Indo-American Chamber of Commerce, member of Economic Policy Advisor Committee, Confederation of Indian Industry Southern Nizar. Now I request our Deputy Convener Shyam Agarwal to offer a digital flower bouquet to our London speaker, sir.
Welcome, sir. Welcome, sir.
Token of our warm regards, sir.
Thank you.
Now I will request our London speaker to start his deliberation, sir. Thank you, sir.
Thank you very much. Good evening to all. And it is nice that DTP has called me once again. DTP is quite a familiar territory for me now. Years back, it started the association when I traveled to Calcutta and spoke on service tax for the first time after 2012 when some of the changes were made. And subsequently that it has been a regular feature, thanks to the organization, thanks to the various office bearers for continuously calling me to share some of my thoughts. And it has always been a pleasure to work to discuss some of these issues with a very learned set of members. I found that the knowledge levels are extremely high. And not only that, there is a mix of direct tax. It's a significantly direct tax practice, but people have also got into GST in a very big way. And therefore, they bring both thoughts together. And that's a very interesting profession to look at. So my topic is cut out today, controversies in input tax credit. That's the discussion which we are having today. And the way I would look at it is that I would try to take you through some of the provisions and then lead you to each of the issues. I've structured a presentation in that format. And after probably about 2 hours or 220 minutes or something, 2 hours, 20 minutes, we'll probably have a question and answer session in case members have additional queries, etc. As far as 16.2a is concerned, I'll come to the middle of the presentation. That's a separate segment by itself. So initially, I'll cover some of the critical issues that are now cropping up in audit. Most of the GST audit are raising some of the key. So with that, I'll go to my PPT. So definition which all of you are familiar is that input means any goods other than capital goods used or intended to be used by a supplier in the course of furtherance of business. Some of you would be surprised as to why should I spend even a discussion time on a definition which is well read and well understood. Well, you'll be surprised that some of the audit queries prompt me to revisit this definition and emphasize on the fact that you are not only talking about used, but also intended to be used. Now, this intended to be used was going to play a very big role in your eligibility to avail tax credit. There are instances where the department is saying that, no, you have not actually used it. I intend to use it. If I intend to use it, I'm eligible as per the definition. And all I have to demonstrate is a nexus to business. It must be used or intended to be used in the course or furtherance of business. So not only in the course of business, but something which will further my business. I'll talk about later what can further my business. So all that will also qualify for input definition. Similar definition is input services. But capital goods definition is structured in such a manner that any goods which I capitalize in my books of accounts would become capital goods. There is no impact as far as the definition is concerned, except that depreciation component is something which will slightly change. So from the income tax perspective, the actual cost could only be the cost of the asset. The GST portion will not be taken as actual cost of those of depreciation, because I've got the ITC benefit on it. Of course, government perceives it as double benefit. One can argue that, both are different laws, but there is a provision. You have to go by the provision. So one decision would be, what is my accounting standard saying? What are the principles of accounting saying? Whether this expenditure should be capitalized or this expenditure should qualify as a revenue expenditure. So that plays a very critical role. So once that decision is taken that this expenditure has to be necessarily capitalized, then it becomes capital goods in that sense. There could be disputes with reference to income tax also, where somebody would say that this is not a capital expenditure, this is a replacement amounting to repair and still not hit by the amendment in 31, and I can qualify it as a business expenditure. So what happens in such a scenario? You would be able to get the full benefit of the deduction in income tax as well as the GST benefit. So you have to do some kind of a cost benefit analysis to arrive at such conclusions. As I said earlier, input service and input definitions are identical. Service used or intended to be used in the course or furtherance of business. So straight away, I'll take to the first issue. Should there be a nexus between input and output? In a number of cases, I found that either professionals or the department take a peculiar view saying that, no, I am not used this input for this particular output activity, and hence I'm not eligible for credit. Now, that may not be correct, because you have to look at the old law. VAT credit, purchase, sale, they have to be necessarily nexus. Excise duty, input, final product, and that to manufacture a final product, nexus. Service tax, input service, output service, nexus. In GST, input service, business. A huge difference. So the intention of the law must not be lost sight of. And therefore, there could be scenarios where I have availed so much of credits. In fact, there is a query which the department is regularly asking, saying, you have lot of credit, therefore it is suspicious. My business has not taken off. COVID has impacted my business. My sales of this particular product has not taken off in a very big manner, but I've spent significant money on advertisement, significant money on promotions. So therefore, the test for credit is the nexus to business and not the use in the various business output revenues which are going to generate or may not generate. Therefore, it is absolutely wider than SENVAT credit and VAT credit. And furtherance of business, even more wider. Supreme Court in CIT versus Balchand observed that it is not open to the department to adopt a subjective standard of reasonableness and disallow a part of business expenditure as being unreasonably large. There's one more query coming up in audit saying that, why have you spent so much of money on this transaction? Well, that is my input service. That is my input. I've got the invoice. I even have the GSTR one filed by the supplier. I have the credits. What is wrong with that? No, this seems to be unreasonably high. No, you cannot raise such questions. All this has been time tested and dusted in income tax. Supreme Court in the case of Dhanrajgiri has observed that it is not open to the department to decide what type of expenditure the assessor should incur and in what circumstances they should incur. And this is a very interesting order of the Supreme Court, where it set aside the order of the Delhi High Court and held that commercial expediency has to be adjusted from the point of view of the assessee. Sometimes department asks the question. Take a case of, let us say you're in a business where you decide to hive off one unit. You have 3 businesses and one business you decide to hive off, and you go through a demerger route. So when you go through a demerger route, you go through the Companies Act requirements, you go through the NCLT requirements, and then the hiving of the division happens. Now, you have to incur a lot of expenses for consultancy, planning, all kinds of promotion expenses, all those things. Now, some are of the view that, no, I may not be able to take full credit because, I've demerged the business. I may demerge the business for running the other businesses effectively. I may get into an IPO for the purpose of generating funds for doing some other activity, some other investment. But the expenditure incurred for the purpose of IPO is for the purpose of business. So one cannot look at anything else except commercial expediency. Why am I incurring the expenditure? The business needs it. Why are you selling off this unit? this business needs it. The other business won't survive. I'm not able to get capital from the bank. I need to get revenue from elsewhere. So that, if you look at, that would be a much more better test and better answers to give, because nexus is to business. Now, by a natural progression, questions have come with reference to COVID. Now you're a manufacturing company. Now, earlier days when you're a manufacturing company, you had Factories Act, and these factories had a lot of compliances, and they continue to apply. So there are a lot of safety gadgets and safety equipment for the purpose of Factories Act. Now, additionally, apart from what you provide as safety equipment for the Factories Act purposes, the COVID-related guidelines. So there are guidelines from the state or guidelines from the center or local orders, etc. They tell you that you must have this kind of gadget in your system. You must have thermometers to check. You must ensure that, you know, the people do not touch the sanitizer. You must have a gadget where you can press by the leg and the whole thing opens. You must have gaps, and therefore you invest further infrastructure in your organization. So you incur a lot of expenses on account of COVID. Now, can ITC be blocked under section 17(5)(b) on the ground that these expenses are not obligated under law? So what is meant by obligation under law? Can obligation under law also include state law? Now, as far as basic safety equipment is concerned, it is clearly for the use in furtherance of business. Now, when you talk about things like gadgets, you talk about thermometers, and you're talking about safety kits, you're talking about testing kits, you're talking about sanitizers and things like that. Unless I incur all this expenditure, if an inspection comes to the local municipality and I'm found not to be COVID safe, in the sense that COVID protocols are not followed, my office or factory can be closed. There can be a seal. Therefore, to survive, to ensure my business is run, I necessarily have to incur all these expenditure. So this expenditure qualified for credit even during the erstwhile excise regime, when it is clearly for the purpose of business. An obligation under law would include even state law. Even a standing order or direction from the government will be fine. And very interestingly, we'll discuss the impact of the Disaster Management Act also. So as I said, anything that you incur for sanitation, anything that you incur as thermometers for checking, safety purposes, etc., you will qualify for credit. That takes me to work from home. Now, what happens in work from home? Work from home for IT industry was a walk in the park. They were already used to IT virtual meetings. They were already working from home. Their companies had systems where they could work from home. But work from home for chartered accountants was new, in the sense that they were used to going to different locations and doing work at different locations. They never worked from home. They were worked in office also. They were working at client locations. And all the time they were at client locations. And from one client location, they'll jump to another client location. Now, suddenly the whole thing has changed. So CA firms are now asking that person to stay at home and he has to work. So he has to have access to the database. He has to have access to files. He has to have client dump data. And therefore, the company has to provide all these facilities. If you're a manufacturer, very rare that work from home as a concept ever existed. Accounts department was always sitting in the factory or in a corporate office. So they had to suddenly buy a lot of laptops, etc. In fact, many of the manufacturers were in the first round of COVID were stuck because they had only desktops. They didn't have laptops. Very few had laptops. So they had to struggle and procure laptops, etc. So now today, what is happening? Bigger companies where you have 1,000 employees, 2,000 employees, 5,000 employees, etc. Many of them sit and work at home. And the company provides the laptop to enable the employee from working from home. Not only that, the laptop has to be secured. You don't want to have any kind of virus related issues attacking that. You want data privacy to be protected. Therefore, all kinds of safety protocols have to be installed in that particular laptop. Who buys the laptop? The company buys the laptop. So if the company buys the laptop, then ideally you should go for a build to ship to method, whereby the assessee will place a purchase order on the vendor and direct him to deliver to the address of the employee. So build to ship to, at least the company would be able to take credit. If they don't do a build to ship to and allow the employee to incur whatever he wants, you buy the best laptop which you choose and then raise a voucher, I'll reimburse the cost, then GST is lost. You can't take the credit. So reimbursement of incremental cost may not be a good idea. Better the company that incurs the expenditure. That takes me to the next element of COVID related item, which is corporate social responsibility. Now, CSR is mandated under the Companies Act. There are some companies who are not even covered by CSR, but they voluntarily do CSR. Now, why do you do CSR? Some persons on account of compulsion, but some people feel that they should also bring their neighborhood up. Their society is their responsibility. And let us say you are in a factory in a far-flung state, in a distance, quite a distance from the city. Then you take care of the nearby villages. You ensure that your community also grows along with you. So when you incur significant CSR cost, and that CSR cost has an element of GST in it, then the question is, can you take the credit? We'll discuss that a bit later. Then you have special insurance schemes, group medical insurance schemes. The state government gives you a directive saying that you can open your factory provided you have taken insurance for all the employees. You can open your factory provided you have taken a COVID insurance for all the employees. So that kind of schemes you take up, can you take credit? Then the question is whether it is treated as personal consumption or not. Madras High Court in the case of Venetian Builders has held that where the assessee is the insured and the beneficiaries are the employees, SENVAT credit is available. So as I said, CSR could involve contractors, vendors. You may buy equipments or some stuff, etc., to give to people, and all that would have a GST element. Can I avail credit? Now, a very interesting judgment of the Mumbai Tribunal in the case of SL Propact has allowed SENVAT credit even on service tax in the earlier regime of service tax system in the Finance Act 1994, where a beautiful observation is made. Sustainability of a company is dependent on CSR, without which companies cannot operate smoothly for a long period, as they are dependent on various stakeholders to conduct business in economically, socially, and environmentally sustainable manner, that is in a transparent and ethical way. So why would I want my community to do well? If my community does well in the area where I'm operating, there is tremendous goodwill. If there is tremendous goodwill, then business grows. The business goodwill is significant. And if I take care of people of the villages from whom those people are coming and working in my factory, if I take care of those relatives and parents, etc., the employee loyalty is much higher with my organization. Therefore, business again grows. The focus is on ensuring brand building and goodwill building, which happens on account of CSR. Now, when that happens, my nexus to business is automatically met. A lot of people argue with me saying that, no, sir, please see Income Tax Act. Income Tax Act explanation 2 to section 37 says you cannot claim CSR expenditure as a deduction. It is not a good provision. I don't know why they are being so petty about it. You have a Companies Act which forces you to incur expenditure. What the government is supposed to spend, the corporate sector is spending. Having spending there, at least you can get a tax break out of it. They have not given income tax purposes. But there is no such restriction in GST. There is nothing in 17.5 which indicates that CSR will not qualify for credit. Therefore, it is open to you to avail the credit interest of CSR if there is a GST element involved. Then we move on to the next controversial topic, canteen. Now, the company engages a contractor. Now, what happens? The factory is located somewhere in the village, and you have employees coming to the factory. Now, if you ask that person to take a tea break, he'll come back only at lunchtime. And then he'll say, I have to go out for lunch. He'll come only next day. So to prevent the employee from going anywhere, you have a canteen and you provide tea, coffee, lunch, breakfast, etc. And all this, you engage a contractor. So contractor provides beverages, lunch, beverages to the employees at the factory or office. Contractor charges, let us say, 100 rupees on the company. And he charges 5% GST. Now, the company does not recover 100 rupees from the employee. Recovers only 10 rupees, which means subsidized food. And if you remember, all these probably somewhere mentioned indirectly in the contract of employment, saying that you will be provided food at subsidized rates, you'll be provided canteen at subsidized rates. So in effect, when the employee joins the organization, he knows that apart from the salary and perquisites, he will also be entitled to partake food in the canteen at a subsidized rate. So a couple of questions. Can the company avail input tax credit? 2, is the company liable to pay GST on the amount recovered from the employee? If so, is it on 10 rupees or is it on 100 or is it on 110? These are some of the questions which are mind-boggling some of the tax authorities as well as the professionals. Let me try to attempt to answer all these questions. Normally, you know my views on AR. I'm not a very great friend of AR rulings because AR rulings 99% is against the SSC. 1% it is favor of the SC. I'm taking one of those cases. So Maharashtra AR, in the case of Tata Motors, in the context of the nominal amount required from the employees for providing transport, ruled that transaction between appellant and the employees is not a supply because there is an employer-employee relationship. Since no service is provided by the employer to the employee, GST is not applicable on the nominal amounts required from the employee. ITC is not admissible to the part of the cost borne by the employee, and thus ITC will be restricted to the cost borne by the applicant. Now, what are they trying to say? They are trying to analyze section 7.1 and say that for 7.1a to apply, there must be a supply for consideration, and it must be in the course or furtherance of business. So first of all, they're saying the company is not in the business of supplying transport. I'm extending the same logic. Company is not in the business of supplying food or beverages to the employee. Second, the amount which is recovered as subsidized 10 rupees cannot be called as consideration. There are enough European precedents on this when the consideration is not, even though we argue that consideration need to be adequate, this is not recovered as consideration, it's recovered as subsidized cost. As far as ITC is concerned, what Tata Motors said was, you spend 100 rupees, GST is, let us say, 5% on that. Don't take the entire 5 rupees. You're recovering 10 rupees from the employee. Therefore, take 90 as your cost spent, and GST on that 90 you can take. So about 4 rupees 50 paisa you can take. Now, these same principles are relevant to canteen-related service. So you can take credit, but to some extent you forego to the extent of amount recovered. If you don't recover anything from the employee, then you're entitled to full credit. What you recover from the employee is only 10 rupees. Does not constitute consideration. Some people argue saying that, no, sir, this is consideration which cannot be ascertained. Therefore, cost plus 10, 110. Mind boggling. Employee to employer itself is not taxable. But what you recover from the employee as cost of canteen facilities or cost of subsidized food, how can you tax it? So you cannot tax that. So subsidized food need not attract GST, nor there need to be a full reverse. Now, are there other judgments? Yes, of course. Apart from Tata AR rulings, there is the Bombay High Court in the case of Ultratech, which held that service tax credit cannot be availed on that portion of the cost of food recovered from the employee, while the balance can be availed. Same principle. So you can take on 90, you cannot take on 10. Now, what happens to the amendments in 2018? 17(5)(b). Proviso provides that ITC will be available where it is obligatory for an employer to provide the same to its employees under any law for the time being in force. Now, most of these bigger factories would be governed by labor laws. Factories Act has a definition which says worker means a person employed directly, indirectly, etc., etc. If you take factory rules, I'll give an example of Tamil Nadu factory rules. The occupier who has more than 250 workers has to provide food, shall provide adequate canteen according to the rules. So there'll be either a standing order or a local rule or a guideline or a notification which mandates this kind of provision of food, which means it is clearly a legal requirement. It is a statutory requirement. Now, suppose it is not a statute requirement in the sense that you have only 50 employees into providing food, then can an obligation under a contract be equated to an obligation under law? Now, that is a very interesting dispute. It's a separate topic by itself. But if you want some kind of guidance on this, you can read the judgment of Justice Ram Subramaniam in the context of sales tax law. By memory is right, the name of the case is HDFC Bank. In that case, the question was whether HDFC Bank is liable to pay sales tax when they sell the, when they auction the goods which are belonging to a borrower who has not paid the loan. So HDFC Bank argued saying that, no, I'm not a dealer. I'm not a dealer when I'm selling these goods, and therefore I'm not liable to pay sales tax or VAT. And then the Madras High Court said, dealer, even though it refers to a person who's required under law to sell, here you're required under contract to sell, you're permitted under the loan agreement to sell. And therefore, if what is permitted by statute can also be permitted by a contractual arrangement. So if you apply that analogy and apply that inference, then it should be possible even for a scenario where there is no mandatory provision, but there is a contract or an employee contract which says you have to provide food to the employee. So next I'll move on to issue number 5, which is 17.5H. Now I'm giving some examples. There is a flood. As a result of which inputs have been destroyed while in storage. Second scenario, inputs are lost in the course of manufacture. Somebody hit the nail wrongly, somebody kept the paper wrongly, or somebody kept the metal in a different place. There is some damage and therefore you chunk it. Input lost in the course of manufacture. Evaporation losses, handling losses. Some percentage evaporates. Under industry norms, so and so percentage is allowed, evaporates. While moving from one shelf to another shelf, some losses. Now, mind you, in all these cases, inventory would have recognized full amount. Purchase invoice will be available. Based on the losses, some write-off would have happened. Or even that won't be happening. They'll book it as consumers. Now, the question is, when should I apply the test for input tax credit? Use or intended to be used? In all these cases, except the first one, inputs are lost in the course of manufacture means inputs have met the test of usage. Usage to business is met. No further test is required. Evaporation losses, it has gone into the process, it has melted, it has become something else and something evaporates. Therefore, it has been put into use. Business test is satisfied. Handling losses, in the course of the operation only something has happened. So what exactly is the scope of 17.5H? Madras High Court in the case of ARS Steel, situations in 17.5H indicate loss of inputs that are quantifiable and involve external factors or compulsion. The loss is because of an external factor, flood, earthquake, tsunami. A loss that is occasioned by consumption in the process of manufacture is one which is inherent in the process of manufacture itself. Reversal in the case of loss of consumption input, which is inherent to manufacturing loss, is misconceived, and such loss is not contemplated or covered by the situations adumbrated under 17.5H. Clean, clear judgment explaining the scope and ambit of 17.5H. There is another confusion in 17.5H. Of course, this is partly because of the view expressed by some. Let us say you are running a factory. You bought raw materials, you bought consumables, you have invoices, you avail the input tax credit, you make the final product. Final product is there in the cupboard or it is there in the inventory. Flood comes, tsunami comes, final product is lost. Should you reverse input tax credit? Now, there is a view across industry as well as department that final product is lost, therefore you have to reverse input tax credit. But the section doesn't say that. 17.5 deals with inputs. You cannot claim on so and so, so and so. They talk about inputs or the goods which are being used. The 5 TC is met. If the output that is generated is lost or destroyed whatsoever, there is no provision in the law which requires you to reverse any proportionate credit. Even if you have to reverse, how do you calculate? It has to be notional. How much of input sitting in the final product? Now, there is no provision in 17.5H to cover this. There is no rule which governs this. But in the SENVAT credit rule, there was an express provision. There was a rule which said, if final products are destroyed, calculate how much of inputs are lying in stock, how much of inputs lying in WIP, and then reverse like this. So if there is no rule, no provision, you cannot be compelled to reverse any ITC in respect of the final products that are abandoned, that are destroyed, or that are lost, or they're just kept away from the business. Again, inputs also, it must be written off. Lost, destroyed, or written off. Loss does not mean, lost and destroyed are powerful words. Destroyed indicates it is gone. Nothing is left. Lost means it has disappeared. Therefore, if inputs are damaged, it is not lost, it is not destroyed. It is still available. The ability to use that as a full-fledged input is not possible because I've got such quality requirements. I've got such input-output norm requirements that I can't use this raw material. But somebody else will use it. I may sell it as scrap. Therefore, use in business is met. Therefore, lost means gone from my site. Destroyed means completely destroyed. Anything in between, you cannot reverse. It can remain in your factory. And that too, they talk about lost, destroyed, or written off. You're all accountants, you know what is it written off. Written off means written off, not a provision for a write-off, not a partial write-off, not a provision for partial write-off. It must be an actual write-off of the entire item. Then only you can talk about reversal. Any other situation, reversal is not required. That takes me to issue 6. In many cases, you have noticed that somebody did not register. Then he was aware that GST was there, but somehow he thought he may not register and survive. But the law catches up with him. And therefore, the department meets that particular assessee and then say, you are not registered from 17. So let us say June 20, they discover. And let us say he has provided service from January 2020. So he immediately says, yes, sir, sorry, sir, I will pay. So he registers, pays all the GST with interest, late fee, penalty, etc. Everything he pays. And then says, sir, I paid everything. Can I avail ITC? Department says, no, you cannot avail ITC. You just have to pay. But I have invoices. That invoices has got my name, has got my address. Can I not take credit? Department is of the view that ITC is not available because registration has not been obtained and section 16 says only registered person can take credit. So let's read 16. 16 of the CS Act provides that every registered person subject to conditions prescribed in the manner specified be entitled to take ITC, which are used or intended to be used in the course of furtherance of business. The recipient must be a registered person. Provision referred to GST charged by the supplier, and there must be a nexus to business. No registered person shall be entitled to credit unless he has an invoice, he has received the goods, tax has been paid, and he has furnished the return. Now, from a case study perspective, the assessee has met all this. There's an invoice. He has received the goods or services. Tax has been paid. He now files the return, of course, belatedly, but he has filed the return. Now, the challenge here is the supplier of services did not deal with the person who's registered and therefore did not know the GSTIN number and did not put the GSTIN number in the invoice. Consequently, when the supplier filed the GSTR1, it will not come and sit in the GSTR2A of the recipient. So my question is it an issue? Of course, the last point is incorrect. The last slide, it is yet to be notified. It's been notified from Jan 1st. So 16.2A has come only from January 1st. So first of all, you cannot read that in the past period. But whether 16.2A has changed the situation, I'll answer a bit later. Now let's take some other sections. Section 18.1. 18.1A provides that a person who has applied for registration under this Act within 30 days from the date on which he becomes liable for registration and has been granted registration shall be entitled to take credit of input tax in respect of inputs held in stock, inputs contained in semi-finished, finished goods held in stock on the date immediately preceding the date from which he becomes liable to pay tax. So there are special provisions which give the credit for some kind of a transition mechanism. But the intention is to give credit, give the benefit. So can credit be denied on input service merely because input service is not mentioned here? How will I answer this? Now I will look at 36.2. 36.2 says, ITC shall be availed by a registered person only if all the applicable particulars as specified in chapter 6 are contained in the document and the information contained in the document is furnished in GSTR 2. Now GSTR 2 is suspended. What has happened today is, let us say you are manufacturing one television set. And in the television set, we are no longer a television, we are talking about a smart TV. And you have all the features. So you prepare the remote first. In the remote, you give all the configurations. You give a button for Netflix, you have a button for Amazon Prime, you have a button for YouTube, you have a button for Google, you put all those things. But in the television panel that you have manufactured, it is not even Wi-Fi enabled. It is not even Wi-Fi compatible. You cannot even give internet connectivity to that screen with a dongle. It can only play Tata Play. Tata Sky is working Tata Play. So it can only do that. It cannot do anything else. Now you have the remote with you, which has all the buttons. What can you do? You can use it as a paper box weight or a paperweight, nothing else. So when we designed the CGST Act, when we designed all the rules, when we designed all the forms, we had a brilliant idea that there'll be a GSTR 1, there'll be a GSTR 2, there'll be a GSTR 2A, there'll be a GSTR 2B, there'll be a GSTR 1A, there'll be a GSTR 3. Of course, 2B was not there. All this was there. So the idea was a purchaser will know exactly what the seller is uploading. He can accept the transaction, he can okay it, and the seller will know when the purchaser has taken the credit. So when we envisaged all this and put all the rules, so the rules are like the remote control button. I put rule 36.2, I put 16.2, I put 4 conditions in 16.2, I put all those things. But in the portal, I say GSTR 2, sorry, it can't be there. 3A, sorry, it can't be there. So major 2 chunks have taken out of the system. How right is the government in implementing all other provisions? Today, government is going hungo, saying that no, it has to match. It should have matched from day one. It didn't match from day one. You can't penalize the ASSI for that period. 2021 onwards, maybe the position has changed. But the last 4 years, there is no business to implement provisions which do not exist. So having suspended GSTR2, having not provided a window for the purchaser to even know whether the supplier has filed data, calling upon the purchaser to do everything and shifting the responsibility to the purchaser is not correct. So in our example or fact pattern, GSTN of the recipient is still missing. So what? So what? Have I received the goods? Yes. Do I have an invoice? Yes. Is the value shown? Yes. Has the supplier charged GST? Yes. I go one step further. Supplier has filed GSTR1? Yes. Department knows. I may not know, but department knows. A supplier filed GSTR3B? Yes. Department knows. They can always cross check. I don't have it in my 2A, nor do I have my GSTN number referred to it. So what? Tribunal in the case of Chamundi Steel. Now, why am I going to old case laws? Old case laws are always relevant because the concept has not really fully changed. Let's go back to MODVAT days. First MODVAT was earlier called a set-off procedure. Then came MODVAT in 1986. 1986 when it came, only input was allowed. It took them a long time to give it to for credit for capital goods. In the earlier days of MODVAT, I have to file a declaration in a specified format for me to be eligible to claim credit on capital goods. 57Q declaration. Assessee bought the machinery, did not file the declaration. Court said that nothing wrong, you can still claim the credit. Now let's look at some of the judgments pertaining to service tax. Karnataka High Court in M Portal, insofar as the requirement of registration department as a condition for claiming credit is concerned, learned counsel appearing for both parties were unable to point out any provision in the SENVAT credit which imposes such a restriction. In the absence of a statutory provision to prescribe that registration is mandatory and that if the registered person is registration is not made, as he is not entitled to the benefit of refund, then the authorities commit a serious error in rejecting the claim of refund. And that is how they decided even a refund case. So I may refund, I may export, claim refund in the current month and ask for refund of the ITC pertaining to the earlier period. Court said, yes, you can claim. Therefore, pre-registration credits have never been an issue in service tax. Why should they become an issue in GST? Tribunal in the case of WNS Global, refunds cannot be rejected merely because they relate to export made prior to the date of the amendment. And SENVAT credit rules board has clarified saying that in the case of incomplete invoices, department should take a liberal view in view of judicial pronouncements. So GSTIN should not be the focus point. The invoice should be the focus point. And if invoice is available and the goods have been received, then credit should be available, is my view, as far as issue number 6 is concerned. Now, this is a very common issue for everybody. You are all aware that GST operates in 2 ways. There is a forward charge mechanism. There is a reverse charge mechanism. So what happens in forward charge? The service provider or supplier of service is required to pay GST. Reverse charge, the lawmaker chooses to shift the liability to the recipient or any other person they've identified. Power is specifically conferred by the statute. Council has to decide what are the categories of goods and service on which RCM is applicable. Now, let us say for a company, they have made some technical fee payments. They have not paid GST under RCM. They've engaged lawyers. They paid legal services fee. They did not know that GST was paid. Audit happens in September 2021. The audit team points out that, sir, for 17-18, 18-19, there is a RCM requirement. You have not paid. So assessee runs around, goes to a consultant. Consultant says, yes, whatever he says is correct. Technical fee is import of service. Place of supply is India. Legal fees again, place of supply is India. Therefore, you have to pay import of services GST. And then the assessee says, can I pay by send by ITC? No, you have to pay by cash. So GST on RCM is paid on 15/9/21 after the audit identifies that it is payable. Now, whether availment of ITC can be done through GSTR 3B. Oh, I have paid. I have the challan. Can I take credit in my monthly return? Or is it barred by 16.4? Can the department say, sir, this pertains to the license technical fee that you are supposed to pay in 17-18. This pertains to the lawyer's invoice, which was rated in 18-19. Therefore, 16.4 comes into play. Time limit is there. You cannot claim the credit. Whether ITC can be denied on the ground that payment had been made only after department pointed out. Let me try to answer these questions. Fundamentally, you have to understand that RCM can be done only through cash. ITC cannot be used. Section 31 deals with tax invoice. Now, 31(3)(f) says, whenever RCM is applicable, the recipient has to issue an invoice. That means a self-invoice has to be generated. Now, who will raise a self-invoice? Only the person who pays the GST under RCM, reverse charge mechanism, whoever pays has to raise the self-invoice. Payment voucher should be generated. Rule 52 deals with payment voucher and is also referred to in 31(3)(g). Now, most important point is Rule 36(1) lists out various documents on which I can avail credit. And one of the documents is an invoice issued as per 31(3)(f) subject to payment of tax. Now, this is very, very important. Now, what do they mean by subject to payment of tax? Can I claim ITC because I've raised a self-invoice? Because Rule 36 says self-invoice is a document? No. The self-invoice is the document provided tax has been paid. So I can never claim ITC unless I've paid the reverse charge GST. Therefore, my document alone plus the payment proof of challan are critical for availing credit, and not the underlying supplier's invoice. For example, a lawyer's invoice will never refer to GST. A foreign technical fellow may not even raise an invoice, he'll just write an email. So the underlying supplier's invoice is irrelevant. My self-invoice or the payment voucher is the document, and payment of GST is the relevant critical point for availment of credit. Therefore, one can argue like this. Payment voucher will arise only when I make payment. Law does not contemplate issue of such payment voucher on a backdated basis. You are pointing out today in 2021, you are saying that 17-18 I should have paid, saying 18-19 I should have paid. But can you ask me to raise a backdated voucher? No, I can raise only today. In September 2021, I can raise a payment voucher. So it is only a procedural requirement. No provision has been contemplated for not raising payment voucher in 17-18. At best, a general penalty of 25,000 can come under 125. Self-invoice will be generated only after payment. Self-invoice becomes a document. Payment of tax becomes critical for credit. And 1751 refers to taxpayer under 74 or 129, 130, which is not applicable because audit stage you have pointed out, you have paid before show cause notice itself. Therefore, payment prior to a scene is always an option available. Since you have made the payment in September 2021, immediately whenever your GST or 3B is available to file either September 20th or October, whenever you can file, take the credit. Will you have litigation? Answer is yes, but these are some of the answers you can give. Otherwise, there is no point in of GST being a tax which eliminates cascading effect. Because please understand, when I'm called upon to pay GST under RCM for 17-18, I'll be called upon to pay interest. Once I pay interest, what happens? It is as if the government collected the tax then. Because what is interest? Interest is a compensation. What is a compensation for? For recouping the loss of the person who ought to have got that money then. So government should have got that money in 17-18. I could not give. I'm making the payment in September 21. 3-4 years I'm paying interest. Therefore, it is as good as the tax paid then. Therefore, government has got the money. Why should I be denied the benefit of ITC? That will defeat the cascading effect principle, which is the whole underlying principle as far as GST is concerned. So credit can be taken in the next available opportunity. Moving on further. Issue number 8. Now, this is an interesting question that is coming up here and there. The question is focused on this. What is the apportionment that is required for treasury income? Now, let us say you have a taxable income, taxable supplies, you have zero rated supplies, you also have interest on fixed deposits, you have dividends, you have redemption of mutual funds, you sell shares. Should I reverse ITC? Should I proportionally reverse any ITC? The question comes critical because in a bigger company, cash flow would not be simply wasted. Cash will not be idle. It will sit in deposits. Investment will be made, you get some dividend. Units could be redeemed. Shares could be sold. All of this will generate some income. All of them will reflect in the balance sheet. P&L. Whether proportionate ITC is required, what is the role of 42 and 43? For understanding this, we need to understand the definition of exempt supply. Supply of goods or services of both which attracts nil rate of tax or which is fully exempt from tax under 11 or section 6. Goods means all kind of every kind of movable property other than money and security. Service means anything other than goods, money and securities. Therefore, when I deal with securities, when I sell shares, when I sell mutual fund units, it is neither goods nor services. Plus, if I have money in fixed deposit and I generate interest, entry in 27 notification 12/17 says there's an exemption for the interest earned. So we are very clear that interest on fixed deposits would be an exempt supply. Now, when you have exempt supply and taxable supplies, section 17(1), 17(2) comes into picture, and therefore rule 42 comes into picture, 43 comes into picture. But you should not get carried away. At the end of 42 and 43, there's an explanation which says value of exempt supply shall exclude, double exclusion, shall exclude services by way of accepting deposits where interest is the amount, except in the case of NBFCs and banks. Which means for a company which receives income by way of interest and fixed deposits, while the interest on fixed deposits would remain an exempt supply, it need not affect your ITC because of the specific explanation on Rule 42. Value of exempt supply under 17(2) shall be such as prescribed and shall include supplies on which recipient is liable to pay GST on reverse charge basis, transaction securities, sale of land. Now here there is a problem. When I sell shares, when I redeem mutual funds, it's a transaction security. When I sell land, it's a third schedule item. So even though I sell land, it is not liable to GST. It might have an impact in ITC. Even though I sell shares on which no GST is payable, it will have an impact in ITC. Even though I redeem mutual funds and no GST is payable on redemption, it will have an impact on ITC. Why? Again, because of the provisions. Explanation provides that While determining value of exempt supply, value of land shall be taken as the same adopted for the purpose of paying stamp duty. Value of security shall be taken as 1% of the sale value of such security. So when I sell the shares, I get capital gains or I get speculative income. Capital gains could be long-term, short-term, whatever it is. I report capital gains. I report as income from capital gains. What they're now saying is, take the selling price of the shares, take 1% of the sale value, treat that amount as an exempt supply. Now, what happens to exempt supply? Then proportionate ITC will go. Rule 42, 43, all those formulas will come into play. Therefore, for shares and sale of land, there is an impact. One can probably argue saying that you are saying that securities is not even goods. You are saying that security is not service. If it is neither goods nor service, it is not even a supply. If it is not a supply, how can you call it an exempt supply for the purpose of proportionate ITC? That's an interesting question you can raise if you're willing to raise a legal question. As far as dividend income is concerned and income from mutual funds is concerned, they are clearly items which do not involve any supply. It cannot be called as supply for consideration. There's no activity done for earning dividend except holding the shares. If something is not a supply, it can never be an exempt supply. Therefore, no reversal of ITC. This again can be argued. Profit on sale of shares. Profit arose only on account of sale of securities. There's no supply because it's neither goods or services. Whether 17.3 is valid when it ropes in transaction securities in the scope of exempt supply, it is not even a supply. But the explanation to chapter 5 is contrary to the provision of CST. So that is something which somebody interested can take up legally. Otherwise, you have to comply with the provisions. Look at the explanation. 1% of the sale value of securities has to be taken if it is shares, or the guideline value should be taken as far as land is concerned, if land is involved. Next important question. There's a restaurant. Now, what happened is GST became too popular. 2017. The biggest problem with GST is that it became extremely popular in the sense that everybody talked about GST. There's so much of campaign by the government that awareness was very high. You are aware of how GST acronym has been described by various people. You are aware as to how so many memes have been created as far as GST is concerned. Political, non-political, whatever. But a lot of activity. In that process, what happened? A lot of people, consumers who went to hotels, were shocked by the bill. Huge amount of GST was charged by the hotel and restaurant. So they took photos of that bill and posted on social media. I just had one small sandwich. Look at the amount I'm paying as GST. So it became a very sensitive issue. Such high amounts of GST for hotels, such amount of GST for food. Given the background that in the pre-GST regime, VAT was very low, 2%, 4%, etc. So council thought about it, and then said, okay, we'll come out with a solution. So they came with a tiered structure, whereby most of the restaurants, smaller restaurants, middle-level restaurants, today charge 5% GST. With the caveat that you cannot avail ITC. Now the problem with this is this. ITC is the, what do you call, life of GST. Without ITC, there's nothing. The beauty of GST is the ITC I can take on inputs and input service which procure. Now, the entire life cycle of GST supply chain is that I should be able to take my credits, I should bring down my cost, and therefore I'm able to give a better price to customers. Now, once you have a sudden notification which says 5%, just 1 second. Once you have a notification that says that 5% is applicable, subject to the condition that you're not entitled to input tax credit, then the whole scenario changes. What happens is that somebody who wants credit is also denied credit. I want to take the ITC, but I'm not able to take credit because I'm under this 5% notification. Now, the assumption of the council was hotels are all very small. They have very small turnover. They buy rice, they buy atta, they buy vegetables, they buy chicken, they buy mutton, they buy fish. All these items, there's no GST. Therefore, they may not need credit. So 5% is fine. Good logic. But there are other fellows, or even this fellow, will have to buy air conditioners, will have to buy building equipment, will have to buy table and chair, will have to buy mixies, kitchen gadgets, etc. Will have to pay rent to the landlord, has to have maintenance. All that has got GST. Now he says, I want some credit at least. So there is a set of hotel fellows who are saying that at least on some items I should get credit. There are others who say that my inputs and input service is very significant. I am running Italian cuisine. All my ingredients are taxable. I'm running a French cuisine. All my raw materials are taxable. I'm running a full-fledged restaurant where the cost of material is very high. I want credit. So question is, can a restaurant ignore the 5% category, go to 18% and avail input tax credit? That's the question I'm asking. Not able to do. Section 17(5) is a non-obstante provision. And it says non-obstante 16(1), 18(1) and provides that ITC is not available on the following items. Entire 17(5), there is no reference to a rate of tax notification or an exemption notification. Conditions for ITC is coming out through section 16(2). There also there is no reference to a rate of tax notification or exemption notification. Rate of tax comes from section 9. And section 9, if you see, there is no reference to ITC. In fact, section 9 says the government, after consulting with the GST Council, shall notify the rate of tax for goods or services that are supplied on an intrastate basis. That's all. There is no power to stipulate that the rate of tax will be married with a condition. There cannot be a rate of tax notification with a condition because that power doesn't come. Rate means rate. There cannot be a conditional rate. This much is rate if you do this. This much is rate if you do that. That is not possible. If you want to do that, you can have different schedules. You can say packed groundnuts, 12%. Unpacked groundnuts, 5%. You can have different entries. If you try to put a condition in an entry, the power is conferred by 9(1), answer is no. 11 gives the power to give exemption. That can be conditional or unconditional. Therefore, you have to look at 11(17). If 11(17) is perceived or seen as a conditional exemption, providing for a 5% rate, subject to a condition, then is it referred to in 16(2)? Is referred to in 17(5)? Answer is no. Now, very interesting. Go back to CENVAT credit rules. CENVAT credit rules had one explanation that said, we have a definition of input service, as per which some of them will not qualify. We have a definition of inputs, as per which some of them may not be inputs. We also have an explanation which says, if any other notification is issued which provides that the exemption is contingent upon non-availability of credit, then that notification shall prevail over these rules. In other words, they gave a beautiful legal sanction to a condition in a notification which prohibited availment of SENVAT credit as a condition for the lower rate. For example, 1% excise duty without SENVAT credit. One notification was there. Now, can a notification say that you cannot get SENVAT credit? No, only SENVAT credit can say. But SENVAT credit said, yes, if they say so, it is fine. 17.5 does not say so. There is no one more enumerated category in 17.5 saying that categories where credit is prohibited under notification issued under section 11. There is no such notification. Therefore, assessees can contend that 11/17 cannot impose restrictions on ITC. There is no matching provision like the earlier system. Then we look at it differently. Second argument or second school of thought. 11/17, if you see the first para, it is issued in exercise of powers available under 9.1, 11.1, 15.5, 16. 9.1 power to notify rates. 11.1. Why should a rate of tax notification refer to 11, which deals with the exemption? 12/17 is already there for exemption. 12/17 has got all the exempted services. 2/17 has got all the exempted goods. Why should 11/17, which deals with taxable services, even refer to 11? Power to determine value for such supplies in the manner prescribed is referred to in 15.5. Restrictions as may be prescribed, it is available in 16.1. So the point I'm trying to make, power to notify rates is a simple power and there cannot be any power to specify conditions. Power to grant exemption does not confer power to provide a deeming fiction where option is not exercised, which means ITC non-availability can be set so only through 17.5 and not through a rate of tax notification. 16.1 does not cover any power, does not confer any power to deny credit. Therefore, reference to 16.1 doesn't help. 15.5 requires rule to be failed. That has not been done. So if you go back to this earlier slide, 9.1 does not give the power to specify conditions. 11.1 is an exemption notification. 15.5, no rules have been prescribed. 16.1 does not give the power to say no ITC. Only 17.5 can say no ITC. So what follows? What follows is that I will look at 11/17. I'll look at the second column, third column, 5% or 2.5%. Then I look at the fourth column, conditions. I will look at this notification as an exemption notification. Otherwise, there's no reference to 11. So it's an exemption notification providing for a lower rate of tax as a concessional exemption married with a condition. Therefore, it becomes a conditional exemption notification. Instead of paying 18% of the full rate, government has exempted you to the extent of 13%, subject to the condition that you don't avail ITC, which means what? It is a conditional exemption notification. Once it is a conditional exemption notification, assessee at his option can say, no, I don't want the exemption. There are two kinds of exemption. Conditional exemption, unconditional exemption. If it is an unconditional exemption, I have no choice. Section 11 says I have to follow that. But if it's a conditional exemption, it is option available to me. I don't want the exemption. I will choose to charge 18% and avail ITC. Now let's look at a very funny way. A lot of people tell me this, sir, you're right. But if I start paying 18 on my restaurant services and avail ITC, department is going to come to me and say, for 5%, you cannot avail ITC, but you availed ITC. Now, what happens if I avail ITC and adopt 5%? Let's imagine a hotel which pays 5% and takes ITC. Department will come and say, you have availed ITC and paid 5%. Therefore, you're not entitled to the benefit of this entry, please pay 18%. He will say 5% is contingent upon you not availing in ITC. Since you avail the ITC, I cannot give you 5%. You have to pay 18%. What is going to be done later? Do it now. You yourself pay 18% and take the ITC. The effect is the same. So as far as restaurant service is concerned, in my view, option is available to charge 18% and avail ITC. Now I'll move on to the most famous topic, which is under discussion across the country, section 16(2) AA. Originally, 4 conditions were there: possession of invoice, receipt of goods, payment of tax, furnishing of returns. Now AA has been inserted. And it also says that details of invoice or debit note referred to in A must be furnished by the supplier in the statement of outward supply and has been communicated to the recipient in the manner specified in 37. Rule 36(4), they made an amendment, GSTR 2B, 1/1/2022. Form GSTR 1 has to be filed. Furnishing of GSTR 1 by supplier becomes a condition for entitlement of ITC. So if you want to go from January 1st, 2022, due diligence of supplies, as one of the earlier speakers mentioned, you have to look at vendor agreements, you have to look at service product agreements to protect yourself and ensure that the vendor pays the tax so that you don't get, vendor files the returns and pays the tax, you don't get affected. Continuous verification followed by the recipients to ensure that GSTR 1 is filed by the supplier. Comparison of GSTR 3B and 2B gets some degree of legal sanction. Net effect is that ITC has become complicated. It has become an illusion. What is the message that the government is trying to convey? Government is trying to convey saying that, look, all of you are associates. We are administering all of you. But there are suppliers, there are recipients. These suppliers must pay the tax. Suppliers must file the return. It is difficult for us to go behind the suppliers. We'll go behind you. So in effect, what has happened, through this section, the message that is conveyed is, if somebody is going scot-free by not filing the returns or paying tax, we will not go behind them and locate them, make them pay the tax, make them file the return. We'll instead come to you and say, reverse the credit. That is the message. What kind of message is this? A tax administration must administer both suppliers and recipients equally. Both are associates. If there is a truant supplier, government should take action. If somebody is not filing returns, government should make them file returns. You can't compel supplier behavior or supplier hygiene through recipient. Now, if this is done, you are putting onerous condition, cumbersome conditions on the back of the recipient for implementation of a law, which is the responsibility and administration of the government. Now, let's take the recipient, poor fellow. There are terrible fellows also, but most of them are poor fellows who are affected by this. 2,000 vendors. Every day they have to do only this. Keep on checking the portal, waste so much of internet, waste so much of power, keep on tracking, send email after email, get response, then check whether, do reconciliation, whether this amount has been paid, that amount has been paid. Continuous follow-up. If you do so much of continuous follow-up, supplier also doesn't like you. There are some suppliers who are very big suppliers. They don't like this communication. Then there are suppliers who have come to you for the first time. They come with a unique raw material. It looks very interesting. You want to test it. You buy it. Now you can't go behind him and impose all these conditions. He will run away. Then there are suppliers who are your suppliers because of non-business reasons. You are forced to engage a particular contractor. You are forced to engage a particular canteen contractor. You are forced to engage a particular vendor. Political reasons, local reasons, compulsory reasons, anything. Where will you recover all these taxes? Whose responsibility is this? Are all not equal in the eyes of law? Therefore, 16.2 AA, in my view, imposes a very unfair and rigid condition on the recipient. And in a way, it allows the supplier of or non-supplier to go scot-free. In fact, government can very well say, look, our system doesn't work. We are not able to implement forward charge mechanism. From now on, everything is RCM. You buy the material, you pay the GST, you take the credit. Easy for us to verify, easy for you also to take credit. That is as good as saying that, we'll take action against you. So what is the government trying to say? You be careful. You deal with only good suppliers. Are there things like good suppliers, bad suppliers in a country where evasion is so high? Have you cleaned up the system so much that everybody is in the line with the law? Has the system completely altered that the government or the industry can say that 100% compliance is there? How many is the percentage of tax assessees? What happens to persons who are yet to cross the threshold limit, but they want to make some supplies? What happens to people who are in a quarterly system of taxation, where the return filing could be later? What happens to MSMEs, small fellows? Now, what is the problem there? Sir, your supplier has not filed GSTR1. Why has he not filed GSTR1? You have blocked him. Your GSTR1 filing will be blocked if you don't file GSTR3B. Why did he not file GSTR3B? Act says, rule says, file GSTR3B. But portal says, unless you pay the tax, the GSTR3B cannot be uploaded. Nowhere in the rules it is linked with payment of tax. But the portal says that if your monthly liability is, let us say, 22 lakhs, 2,20,000, and you have 60,000 ITC, unless you find cash of 1,60,000, you cannot upload your GSTR3B. This fellow has got a cash flow problem. He has not paid his employee. He's got loans which are outstanding. COVID has finished him off halfway through. He's got PF dues. He's got some other bank-related claims. He's not able to manage his funds. He's not able to pay 1,60,000. He has 1,40,000, not enough. 1,60,000 if he pays, only return will be uploaded. So that month he didn't file. Next month, it becomes multiplicative. The problem multiplies. Again, he's not able to file. Now, because he didn't file GSTR3B, his GSTR1 enabling is also gone. So he doesn't file GSTR1. But you want his material, you have got that material. So in a way, the provisions are putting tremendous pressure on the entire supply network. Huge pressure on MSMEs and SMEs because they will operate only on the whims and fancies of the bigger players. The bigger companies would say, unless you do this, you can't supply to me. But not always. Not all suppliers can fit the law. So there will be compromises. And what happens in compromise? The bigger company will say, I will forego the credit. I will lose the credit. That becomes GST collections. GST collections is going up. Probably one has to do a microscopic analysis of how the GST collections is going up so much. Is it only because of sales going up, or is it because of lesser ITC? If it is because of sales going up, I'm very happy. Excellent. Goods and services are doing very well and country is on the right path. But if it is because of lesser ITC claims and moreover, more and more of non-claiming ITC, then we are killing the system by increasing the cost and we are defeating GST. Now moving on further. I will threadbare analyze 16.2. 16.2, possession of tax invoice, receipt of goods or services, tax in respect of supply has been actually paid, furnishing of return. And now after the new amendment, the GSTR1 has to be filed. So let's look at possession of tax invoice. What is possession? Is it mandatory to maintain physical copies? GST itself has gone to e-invoice regime. GST itself is IRN based. And Information Technology Act says whenever something is required to be in writing, it is deemed to be satisfied if it is available in electronic form and accessible. So long as you're able to access and download this, it is possession. You have met the condition of possession of tax invoice. He has received the goods or services. He means recipient. Receipt of goods is mandatory. Now, a lot of people say that e-way bill is there, proof is available. I'll give you an example. there is an open land. A imports coal, keeps it in the open land. Huge quantity of coal. A finds a buyer, raises invoice on B, selling the coal, pays GST, pays cess, etc. B sells to C. Coal is still there in the land, but ownership has transferred two hands. Where is the e-way bill? There cannot be e-way bill because e-way bill under 138A is only if there is movement of goods. Now, receipt of goods is mandatory. There is a constructive receipt when I get the invoice. There is constructive receipt when I make the payment. There is constructive receipt when I acknowledge that there is a title transfer. Sale of Goods Act talks about transfer of title. So there can be a constructive receipt instead of an actual receipt. So without e-way bill also, it is possible to demonstrate receipt. Concept of a GRN. If there is a company which has got a big environment and a lot of materials keep coming in from different locations, they can ensure that receipt is proven through goods received note. So sometimes you are forced to create physical documents because of the requirement of business, because of the requirement of law rather than business. In business, you may have dispensed with GRN, but GRN would have come back because you have to prove that receipt of goods is happening. Why? Most of the fake invoice issues involves around non-receipt of goods and mere issue of invoices. Assuming I can prove goods receipt, how will you prove receipt of services? So and so contractor has provided consultancy services. How do I prove it? Yes, provided. How I've used it? I paid him. I may even junk the report. I've availed the services. Section 16.2a says he is in possession of tax invoice. Yes, I'm in possession. 16.2b says he has received the goods. Section 2d says he has furnished the return. He can only be the recipient. Therefore, supplier filing a return for ITC entitlement of the recipient is not a correct interpretation of 16 prior to January 1st, 2022. All these years where the department has insisted that supplier must have filed his return for the buyer to be entitled to receipt, entitled to ITC is wrong. Why? Read it again carefully. 16.2d says he has furnished the return. That is the recipient. 16.2a says supplier has filed the return. So for the very first time, supplier filing the return is becoming a condition in 16.2. It was not there before 1st Jan 2022. It is a prospective amendment. It is not a retrospective amendment. You cannot read this law prior to that date. One other condition in 16.2 is that supplier must have paid the tax. Now, I would read it like this. I'll go back again. He is in possession of a tax invoice. So if I want to avail credit, I must see whether I've got the tax invoice, which means it is a condition which I need to check at the time of availment, pre-availment. He has received the goods. I have to check whether I've received the goods. Pre-availment test. I should furnish the return as a recipient. Obviously, I filed 1 month later. Therefore, it is after availment. I'll show my availment only the return. Supplier filing the return can only be a condition post-availment. See, one should not get confused by the fact that all of them come in 16.2. By their very nature, some of the conditions are pre-availment or at the time of availment. Some of the conditions are post-availment. I would say payment of tax by the supplier is also post-availment. Possession of invoice, receipt of goods are current events, whereas payment of tax is not a simultaneous event. Payment of tax happens later. And I can claim ITC through self-assessment. Therefore, I would interpret that 16.2c should be seen as a post-claim condition and not as an eligibility condition. Waiting for payment of tax by a supplier to claim credit may be unwarranted. At best, this is a condition that can be checked during audit. During audit, you check, but not at the time of availment. In fact, whether insisting that supplier should pay the tax being a condition for availment of ITC has been challenged in the Delhi High Court in the case of Bharati Telemedia. VAT judgments, Madras High Court, department is not empowered to revoke the ITC availed on the ground that selling dealer has not paid the tax. When the petitioner has paid the tax to the selling dealer and claimed ITC waive self-assessment. I have paid the vendor. I looked at the portal. His name was there. His number was there. Basic diligence I've done. He has given a sample which is good. I have placed a purchase order. He has also supplied. Invoice has come. Through bank, I've made all the payments. Vendor bill is settled. GST is settled. If that fellow doesn't pay tax to you, go behind him. Non-payment of tax by the supplier cannot be the ground to reverse ITC in the hands of the buyer. T and VAT judgment, Madras High Court. Delhi VAT does not make a distinction between purchasing dealer and bona fide purchasing dealer and other buyers. Provision should be read down whereby dealer or class of dealer shall not include a purchasing dealer who has bona fide entered into a purchase transaction with a validly registered selling dealer who would issue tax invoices. So you can't paint all recipients with the same color. Recipients who paid the vendors the invoice value and the tax amount would stand on a different footing compared to a person who has just received the invoice and has not made the payment. Of course, Maharashtra, Bombay High Court has not accepted this provision. So I bring back this principle. Lex non cogit ad impossibile. That means doctrine of impossibility. It is impossible for me to check whether a supplier has paid tax. It is impossible for me to verify whether this transaction supplier has paid tax or not. Therefore, you cannot apply all these conditions at the time of availment or avail the credit. You can examine this at a later point of time. So I'll put this in a very simple perspective. Can GSTR 3B and 2A be compared for 1718, 1819, 1920, and up to 311221? I repeat, can GSTR 3B and 2A be compared for 1718, 1819, 1920, 2021, up to December 31st, 2021? Answer is no. Practically, what has happened? Everybody gets a letter. Somebody is asked to reverse interest. Some people have paid interest also. Some people have been called with penalty also. There are mere letters, no show cause notice. Summons from DGST saying that please reverse this amount. Can filing of GSTR1 be a condition for availment of ITC by the recipient for the period prior to 1/1/2022? No. For the period after 1/1/22, yes, but subsequent. Otherwise, the other provisions will collapse or become OTOs. I'll give you an example. 16.2 says, if you don't pay the supplier within 180 days, you must reverse the input tax credit. Please note carefully. If you don't pay the supplier of the goods, the value and the GST portion, you must reverse the input tax credit. So what does the law say? You have already availed the credit. You have not paid the supplier. 180 days is over. Reverse it. After you make a payment, take it back. Therefore, my right to avail credit is already available. It need not wait for my supplier to pay the tax and supplier filing the return. So supplier filing the return should be perceived as a post-availment verification. I'm not saying it is gone completely, but if you forever wait for him to file the GSTR1 and then take the credit, that doesn't make sense. There are quarterly taxpayers. There are people who may get delayed or they have technical difficulties in filing the GSTR1. I can't be affected by all of that because I have paid the vendor, I have paid the GST within 180 days, and therefore my original credit avail should not be affected. There are some states which have not even notified the amendment to 16.2. What will happen to that? But portal doesn't believe all that. Portal believes as soon as central government notifies, portal will also change. Skip that. So I will conclude by this. Non-reflection of invoices in GSTR 2A does not impact the ability of the recipient taxpayer to avail ITC, provided he has met all the other conditions. Filing of GSTR 2 and 3 remain suspended, and therefore 4210 and 4310 will not apply. There cannot be even a liability to pay interest under 53, because 50 subsection 3 is linked with 4210 and 4310. None of them apply to this kind of a situation. So arguments are like this. Prior to 1/1/2022, you cannot compare 3B and 2A. Any exercise of comparing 3B and 2A is illegal. Amendment is prospective. Entire past period, you cannot ask questions. Post, I will check and ensure that he files, but not at the time of availment, because availment is cash flow. If I avail only, I can utilize my credits. And what is the Brahmastra you can use? The latest Supreme Court judgment, Bharti Airtel. Registered person is obliged to do self-assessment of ITC, reckon eligibility to ITC and output tax, including balance amount lying in cash or credit ledger, primarily based on his office records, books of account. He can do so even without the portal. See, in this case, what happened was, the assessee argued saying that I was waiting for it to come in 2A. Since it did not come in 2A, I did not take the credit, even though in my books I could have taken the credit. In fact, it is there in my books. Supreme Court said, if it is there in the books, why didn't you take the credit? No, sir, portal, it was not there. Why are you waiting for portal? You have your records, you have your invoice, you have your books, take it. So even though people perceive that this judgment is against the assessee, this judgment actually gives a very interesting perspective by saying that portal is only another factor. Your eligibility to flow from your record and books of account and invoices. The primary source is the form of agreements, invoices, challans, receipts of goods and services, which are maintained by the assessee either manually or electronically. This judgment also said AAP judgment is not correct. Therefore, Gujarat AAP is no longer good law. But Bharti Airtel, while deciding whether GST or 3B is the return and all, ultimately said, who stopped you from taking credit? Portal cannot be the reason for you not to take credit. It was there in your books. So this is the Brahmastra you can use to argue that you're entitled to credit. Now I move on to the next biggest racket, the fake invoice and the income tax impact. Now, what is a fake invoice? It is not a duplicate invoice. It is an invoice without any supply. Government seems to be very worried about it. Partly they should be worried because it is not a legal transaction. But so much of attention is not required. Because what happens with so much of attention is that you become obsessed with it. If you become obsessed with it, what happens? You change the law so much. You tinker with the law so much that other fellows who are genuine fellows are also affected. It is like this. Suppose you're running a shop. You're running a departmental store. You have some 1,000 kinds of goods which you're selling. Big floor. Now, some shoplifting will happen. Some fellow will steal a toothpaste, some fellow will steal one biscuit, something will happen. Now, you calculate, oh my God, this 0.2% shoplifting is happening. How do I stop it? So you spend all your energies, put webcam, this cam, that cam, everything you put across the thing, put security fellows, this side, that side, etc. And still 0.1 becomes 0.5. And you're still obsessed with it. Which means what? You will never do business. You only focus on this. This is not my language. The percentage may be my language, but this is the language of Palkiwala. He said, if you focus on shoplifting, your business will not grow. Yes, there will be a percentage of loss. Now, what is this supply, invoice without supply? Is it something unique to India? World over, it is happening. Every country that has got GST, every country that has got VAT has got this, what you call as round tripping or circular trading or carousel, as they call it. Multiple fellows doing the same kind of transaction. So this is an unscrupulous method, no dispute. Only to facilitate ITC, no dispute. But when is there a loss? When ITC is used to pay GST or the ITC is obtained as a refund, then there is a loss. But somehow the authorities seem to think that there is a loss in all transactions. And therefore they recover from the first fellow, second fellow, third fellow, fourth fellow, fifth fellow. Imagine this. I'll give you an example. A sells to B. Fake transaction. B has availed ITC. Now department questions B. B sells, I have sold to C. That's also fake transaction. C avails ITC. C says I have sold to D. That's also fake transaction. Now what the department does is A should pay, B should reverse, C should reverse, D should reverse. On one transaction, which was not even a supply. 4 times collection. Now, the logical question one should ask is, yes, you went to B. He had an invoice, but no goods. You said you cannot take credit. Fine, let him reverse the credit. What happened to the tax paid by A? You have kept that money. Should not the government refund that money to A? Why? The government's point is that, department's point is that this is a fake transaction without an underlying supply. If there is no supply, how can the department or the government retain the GST paid by A? The GST paid by A is no longer GST. It should go back. Therefore, fundamentally, something is wrong in the assumption that there is a revenue loss across the chain. There is one loss somewhere when somebody claims refund or when somebody utilizes against a genuine GST liability. This is one story. Second story is, there is a supplier who has generated 100 fake invoices. But he's also a good supplier for 200 people. And he has raised invoices for those 200 goods, where goods have actually gone, invoice also gone. Now he is caught for this 100 transactions. And he gives a statement. Yes, sir, I committed fraud. I generated fake invoices. Give me a list of buyers. All 300 buyers are given. Next department goes to all 300 buyers. Now 200 of them are genuine. They bought the goods. So everybody is given the pressure saying reverse the ITC, otherwise arrest. There will be threat. So tremendous amount of pressure and coercion is also happening. I'm not saying that there is no fraud. There is an element of fraud, but it is not across. It is there at some segments. You identify those segments and take action instead of assuming that all buyers have committed fraudulent transaction. In most cases, cross-examination is never done. Statements are made as if there is no actual sales under pressure. Now, these statements are used to the other fellow and saying he's given a statement, reverse the credit. Now, the other party is scared. He says, after all, ITC, I'll reverse it without checking whether the statement is correct or not. Without cross-examining. Nobody asks for cross-examining. They simply reverse with interest. Now, you do all this. What happens in income tax? Adverse findings are based on statements taken from others. Assessee is entitled to cross-examination, well established. If statement is given against you, you can ask for cross-examination. If it is not given, the entire proceedings collapses. You cannot, that evidence cannot be used. Through cross-examination, you can counter the statements. Reversal before investigation is completed need not necessarily mean that the matter has been accepted or conceded. You can always contest the matter even after reversal. You can say that let the show cause be issued, I will contest that matter. Now, when this information goes to income tax, the income tax will say, you have reversed the ITC, therefore your purchase is not genuine, purchase is bogus, therefore expenditure will be disallowed. No, I have reversed the ITC, but I will contest the matter on the show cause issue because there is only investigation stage. I have not accepted the liability. So let the SCN come. Investigation would involve collection of data, statements will be taken after summons, inquiry should happen, ultimately show cause will be issued. Once a show cause issue, you are entitled to give objection to the proposals. After that, there is an adjudication process, an order is passed. If an order is passed, you have a right of appeal to first appellate authority. After that, you even have a right of appeal to GST tribunal, though it doesn't exist, and subsequent to High Court and Supreme Court. Therefore, reversal during any of the stages need not mean that the purchase or expenditure becomes bogus. Reversal to buy peace or under pressure or coercion need not tantamount to the fact that the transactions are bogus. Reversal could be just to obtain bail. Sometimes arrest provisions are so much, threat to so much, you go to ask for anticipatory bail. The criminal court asks you a question, what is the amount involved? This is so-and-so amount as well. How much are you willing to reverse? We'll give you bail. So you commit an amount to reverse so that you want your freedom. Now that doesn't mean that the transaction collapses. So you should always retain your rights to contest the matter if the transaction is genuine. If the transaction is bogus, then take the opportunity, reverse the credit, ensure that penalty is at least eliminated by taking the reversal of credit and the interest. So it's a very important call as to where you stand, whether it is a genuine transaction or a malafide transaction, and what chain of transaction you are in. So purchase or expenditure can be questioned by the department. You have to give appropriate answers. There could be proposed to disallow expenditure. Cash deposits, cash withdrawals may require explanation. As I said, there are interesting issues, A, B, C. Can there be disallowance of purchase in the hands of both B and C? If one person's purchase is bogus, sale is also bogus. So you cannot take only one side action. The sale also must come down. Otherwise, it's become a notional income tax. Your revenue alone is higher, your expenditure is coming down. So these are all going to be new issues that are going to be fought in courts and ultimately land in the Supreme Court. Of course, income tax, you also have a penalty in terms of 271 AAD. Without prejudice to any other person, the act, if during any proceeding under this act is found that in the books of the account maintained by any person, there is a false entry or an omission of any entry which is relevant for computation of income to evade tax liability, assessing officer may direct such person shall by way of penalty a sum equal to aggregate amount of the false entry. And this can apply to other person also. It could be an employee of the company also, 271 AAD. So virtually what happens, income tax is entered into bookkeeping. There are enough penalty and prosecution provisions in GST. Why should they also bring income tax as question? What is the need for another penalty in income tax when the expenditure disallowance can always be tested under concealment? 271C can always apply. 276C deals with prosecution, where it talks about making or causing to make a false entry. So what is already there? Why do you want to put another 271 AAD? Just to give that, as I said, too much of attention for the minute shoplifting that happens. But if you want to look at 271 AAD as an interpretation point, false entry includes use or intent to use, therefore intent has to be established. Objective must be to evade tax liability, and this will has to be established. Assessing officer may direct, which indicates discretion. 274 would require show cause notice, and therefore show cause notice has to clearly establish what is the violation for penalty to apply. Moving on further, ITC other issues. I bought the goods. I've availed the services. I looked at the portal, his number was there. Then suddenly department comes and tells me, you bought from ABC suppliers. We have cancelled their. Very good. So what? You must reverse ITC. Why? We have cancelled with retrospective effect. How do I know? You cancel with retrospective effect. That is not my problem. At the point of time when I bought the goods, he was a valid registered assessee. I have received the goods when he was a valid registered player. Madras High Court said that retrospective cancellation of supplier's registration cannot affect buyer's credit. ITC availed by petitioner could not have been proposed to be reversed on the ground that the selling dealer has not filed returns or paid taxes. These are all precedents which can be used and tested for section 16(2). Moving on further, blocked credits. I'm not talking about blocking of credits, but blocked credits. Now there is a new problem. It's a very funny problem. GSTR 3B is your return, effectively. After a judgment of the Supreme Court in Bharati Airtel, 3B is the return. We have to accept that. 3B reflects all your transactions. GSTR 1 gives information about various other matters also. For example, a company pays a law firm a certain amount for legal services. A company pays a goods transport agency. Now the company discharges GST under RCM. Right? Matter over. Now there are certain transactions where the company is not liable, but somebody else is liable. RCM. What you pay as RCM is different. What somebody else has to pay as RCM is different. So where somebody else has to pay as RCM, you report in one. Now officer says 3B shows 1,000 rupees, 1 shows 2,000 rupees. That's the difference. GSTR 1 has got so much other information which is not necessarily there in 3B. That need not mean that they are liable to tax. Unfortunately, that seems to be the thinking in audit and reconciliation. GSTR 9 and GSTR 9C. You give a list of items on which you don't take credit. You have also not taken credit, but you give a list of items which you are saying ineligible credit. Officer says you have taken ineligible credit. I have not taken in 3B. I've reflected in 9. But notice has come, you have to reconcile. You have to spend hours and hours trying to find out what is the difference, and then you find that it is actually something in 9 and 9C. That is one story. Second story is, can a developer avail credit of GST charged by contractors? Yes. Can a developer avail credit in respect of GST charge by supplier of services? Yes. Now, I have not come to 5% yet. I'm still general talking. Can a contractor avail credit of GST charge by subcontractor? Yes. Can a mall avail credit of GST charge by contractors for building its mall? Now, in the first question, can a developer avail credit of GST charge by contractors? Notification 3/19. Third column, 5%. Fourth column, various conditions. You must buy 80% from registered fellows. You must do this. You must do that. You must don't do this. You must don't do this. All these are conditions. Whatever I argued or explained for restaurants will equally apply for developers. So 5% can be perceived by the developer as a conditional notification, conditional exemption notification. You can forego the exemption and choose to charge 18% if he wants to take the ITC. It is available. Second, developer is there. He enters into a joint development agreement with the landowner. You have the latest judgment of the Mumbai bench of the tribunal. Mumbai bench of the tribunal and service tax held that redevelopment is not taxable. And why did they say that? Simple accounting principle. In a joint development agreement, landowner comes to me, I'm the developer, and says, please take my land, develop it. How many flats will you get? 100. You keep 60. You give me 40. I agree. So I hand over 40 to the owner, or I agree to hand over 40 to the owner. 60 I will market. Now this 40 which I have to give to the owner, I have to buy cement, steel, etc. and construct. I pay from my hand. I incur all the cost in putting up the entire 100, which includes that 40. Now I'm not running a charitable organization where I say, okay, I like this landowner, therefore I spend money on it. Entire cost which I incur for this fellow, I will keep in mind, along with the cost incurred for 60, along with my profit margin, I fix the selling price for the 60 apartments. When I charge 10,000 rupees per square feet on one of the apartments of the 60 apartments, in effect, I'm paying GST on both. So the cost is already captured in the selling price of my eligible apartments or allotted apartments. Therefore, entire GST has been paid. There need not be a further GST on construction for the landowners. Is the principle of what is known as the Basanta Green judgment of the Hyderabad bench of Sestat, which has been applied in the latest Mumbai bench of Sestat. The same analogy should equally hold good for GST. But suppose somebody says, no, sir, I don't want to take all that risk. This is again means I have to go to Calcutta Tribunal. I don't want to fight all those matters. Is there any other solution? Pay GST on landowner share. Please put that in the joint development agreement. Otherwise, you can't collect the GST from the owner. He's going to quote all these case laws. How do I charge GST on the landowner? 3/19 says, compare the selling rate and adopt it. No, that's unfair. The selling rate to the market is the perception of the customer, and that price already covers all costs. It is not a comparable data. It's like apples and oranges. The selling price of an apartment to a customer cannot be the same because it has factored irrelevant costs, so to say, when it comes to landowner. So what is the cost for the landowner? What I spend for constructing is 40 apartments. Therefore, is it not possible to say that I will adopt the cost of construction plus add 10% margin for landowner share? Possible. Then what will be the rate? Charge 18% and take ITC. Because what is effectively in a joint development, the landowner is already the owner of the land. You are only a contractor. The developer is wearing a hat of a contractor. So he is the developer for 60 flats. He is a contractor for 40 flats. So for 40 flats, 18% GST with ITC, possible. For 60 flats, take 5%, don't claim ITC, maintain rule 42 books and accounts, etc. So that should be a possibility for a developer. Now coming to the mall. Why is it an issue? 17.5C and 17.5D says that works contract services, when supplied for construction of immovable property other than plant and machinery, except where it is an input service or further supply of works contract service, you cannot take the credit. So there's a huge impact on factories, warehouses, godowns, theaters, malls, commercial buildings, etc. So question comes as, what is immovable property? By now, this dispute is well across the country. So you have to look at whether it is immovable by very nature, or it is immovable because of the fact that it has to be annexed to the ground, without which it cannot even function. What is the object of annexing to the ground? What is the degree at which it is kept? Can it be easily removed? These are some of the questions you keep asking to arrive at a conclusion, whether it is immovable property or not. Even otherwise, you don't want to get into all this debate. Rely upon the Orissa High Court judgment. Safari retreats which said that despite 17(5)(d) saying that credit is not available, it has to be read down, because the philosophy and principle of GST is that ITC should be available. They applied the Acer Motors principle, and the very purpose of credit is to give benefit, and Safari retreats was given in favor of the SSC. It is now the same issues pending for the Karnataka High Court, same issues also pending for the Bombay High Court. Orissa High Court judgment has gone on appeal, department has gone on appeal to Supreme Court, matters are pending for the Supreme Court. So we'll know what is the outcome after some point of time. So I've taken about 2 hours. I'll take the last slide as reforms needed in GST and then open up for questions. In my view, these are some of the reforms that are critical. First issue is inverted duty structure. Government is trying to solve it in textiles by increasing rate of GST, which was opposed vehemently, and they withdrew it. But inverted duty structure is something which they have to address it. They have to go deeper into the provisions and modify it, whereby the raw material rate should not be higher than the output rate, and services should also be factored in inverted duty structure. Otherwise, no point in giving refund only for goods. Transitional credit. There was a recent brilliant judgment of the Calcutta High Court, where they said that he tried accessing the portal, he could not access. There is no proof that he tried filing Tran 1 or he could not fail, etc. Whatever it is, let him take in 3B now and finish it off. You verify it later. So I think somewhere government should take a conscious decision and probably in the budget announce that even people who have missed the Tran 1, people who have had errors in Tran 1, people who did not do Tran 2, all those things, let them claim in one window, GSTR 3B. GSTR 3B up to 31st March. If you claim it, it will be accepted, but subject to verification. Show cause notice today, it's very, very wide. The time limit is extremely wide. 73, 10, 11, 12, if you read together, it is quite wide. They should go back to the excise regime or service tax regime. 1 year general cases, of course, 180 days, they change it later, then 2 years, they change it later, but let's keep it 1 year. 1 year general cases, 5 years for fraud suppression, or even borrow the income tax latest 148A, 3 years, about 3 years if it is only certain circumstances, then only you can reopen. That kind of finality is required. GST on advances. For advances for services, there is GST. Advance for goods, there is no GST. I don't see the logic behind this kind of distinction. They have to make both not taxable. GST tribunal urgent requirement, because a lot of appeals have been decided and there is no further action unless you file an appeal. Of course, you may have the time limit, but you need the money. Refund is blocked. Most cases are refund cases. AAR, they have to redo it completely. This current format doesn't work because if you have sitting officers, if you have judicial members, then it will have a very role to play. It becomes an institution by itself. Audit proceedings, audit takes place, no report is given. You assume that everything is closed. Then comes a notice again, asking for the same data. Now this is just dragging on up and down. If audit takes place, there must be a finality. Yes or no, I agree, not agree, one report should come. Returns, everybody makes mistakes. Humans tend to make mistakes. Returns, errors can happen. Ease of doing business would mean revision of returns. And we have to get over this concept of blocking ITC, closing ITC, blocking GSTR filing, non-permitting somebody to do something, putting condition that no ITC should be available. All this should go. True GST means there must be no cascading effect of taxes. Ease of doing business would mean that you remove all these blocking related portions, because otherwise it's no point of calling it ease of doing business. So with that, I've concluded my session for the day, covering all the complex issues as far as GST is concerned. I'll be glad to open up the questions box. If there is a chat box question, somebody can read out those questions. I'll be glad to answer. And thank you so much once again for a very patient hearing.
Hello.
So can I ask a question, sir?
Yes, please.
So, section 16(4) specifies a time limit within which ITC is to be amended. Section 16(2) starts with a non-obstante clause which overrides section 16(4). My question is whether both section 16(2) and 16(4) run parallelly. We need to satisfy both the conditions. I have filed the return within 20th October to say 21. I've missed to avail certain credits. I can understand I won't be eligible to claim the same credit again. But if I have not filed return at all, I am filing return in the month of December. So whether 16(4) comes into picture then, because I am not satisfied the condition of 16(2)(d), I have not filed the return then.
The question is this: if filing of return by myself or the recipient is a critical condition, and that condition happens only belatedly, am I not entitled to credit? Now,
Yes, sir.
if you, the department would say that no, sir, pre-received 16(4), you have to look at the underlying invoice, etc. But the question is this: can denial of ITC operate like a penalty? ITC is supposed to eliminate cascading effect of tax. Government is very clear that we want the tax. Fine. Tax is paid. When I belatedly pay the tax, government is compensated adequately with late fee and interest. Interest is calculated and paid. Now, the moment you say interest is payable from the date the tax was due till the date the tax was paid, that means the tax is as good as paid on that date. So the analogy or the logic which I applied for RCM related credits, which I discussed, or the analogy which I talked about pre-registration credits, the same analogy would apply here. One can probably argue that when I file the return, I'm entitled to claim the credit. You can also look at, of course, the department is going to say that 16(4) is putting a time limit. The problem with the case laws in the subject is excise set of case laws have always said that time limit is not important. VAT set of case laws, somehow precedents were generated which said that time limit is important. But if you critically analyze the VAT case laws, the question before the Supreme Court was not that. The question for the Supreme Court was something else. So while deciding that issue, they overall talked about input tax rate and the importance of time limit, etc. So a future bench will have to distinguish some of the VAT related Supreme Court judgments and apply the excise principles in the context of time limit, and then hold on to say that a benefit cannot be denied on technical reasons such as time limit. In fact, I'll give you another example from income tax. There is a judgment of the Karnataka High Court in the case of Wipro, which said that foreign tax credits can be claimed even during assessment. A benefit cannot be confined only to the returns. And one other interesting argument you can build from Bharti Airtel. Bharti Airtel said, if you have claimed in your books of accounts, that is good enough. So books of accounts, if you have claimed in you have recorded the transaction, you have recorded the purchase and only omitted to claim it in the return, that need not be a mitigating factor if you rely on that para in Bharati. I hope I've answered your question.
Thank you, sir. So when we talk about the ITC as a right, there are judgments which say that ITC is not a vested ability concession, and there may be restrictions and conditions related to that. Supreme Court judgments are there.
That is exactly
right?
what I said. No, that is exactly what you got the point. ITC or Senvat credit being a right is well established in Daiichi Karkarya as well as Acer Motors Supreme Court in excise case laws. ITC being a policy and therefore the whims and fancies of the government can apply is a principle which flowed from the judgment of VAT. But as I said, if you go and read the question of law before the Supreme Court in those judgments, the question of law was not whether it was a right or not. The question of law was whether 1920 is prospective or retrospective.
True,
Whether
sir.
19, yeah.
Thank you, sir.
Any other question?
Yeah, chat box, some questions are there, Mahendra.
Shyam, please check the chat box. Is there any question?
Yeah, just a second.
संदीप भैया शायद unmute करिए अपने आप को.
There is only one question, but I am unable to see it in the chat box as regards to reversal of ITC on slum sale on transfer of business
Yes,
as a
please.
going concern.
Now, when you do a slum sale, where a division is sold off, lock, stock, barrel, contracts, employees, etc. First principles, can you call it a supply in the course of business? I'm not in the business of selling businesses. Therefore, it is not even a supply. So technically, there is no exempt supply. But for whatever logic or reason, government declared it as an exempt supply. Now, when it declared it as an exempt supply, they're only saying that don't pay GST on it. But if you read section 18, 18.4 or something, there is a provision that says that where a business is sold, where there is a lease or where there's an amalgamation or demerger, etc., the credit attributable to the transferor will be transferred to the transferee by a press of a button. ITC, one particular form you have to upload, he has to take it, automatically it will move from this ledger to that ledger. Therefore, if I have to philosophically use this, body and soul are together. Though the real philosophy will say that body is different, soul is different, and soul is a true person, body is an artificial thing that exists. But at least we believe that when a person dies, the soul also goes along. So if you apply that logic, the business goes, the credit also goes with it. The entire ITC pertains. So you draw a balance sheet, you draw a line in the balance sheet. This business is getting transferred. These are the ITCs pertaining to that business, transferred to that fellow. Remnant ITC is my business, retained business, I will keep it. So there is no reversal, but you may have to give the ITC to him as part of your transaction.
There are some questions in the chat box. Sandeep bhai.
Yes.
Sandeep, yeah.
Please unmute. Shyam,
There was one question only which I have already put before, sir.
Sir, there are many other questions.
I can see, can I read an answer?
Sir, yeah.
Yeah, one of the questions is IGST paid on imports, but it is too much down. Can you, somebody can move
I can I just read the questions if required?
please, Shyam.
Yeah, please.
So Mr. Chetan Gujarati has asked, plant and machinery is transferred from one distinct person to another in another state for construction purpose. Once purpose is served, machinery is sent back to original unit. What's the GST impact on these transactions? Paying on such transactions again and again is huge blockage of cash flow. This is the question.
Yeah, I understood the question.
Yeah.
The problem is they have a registration in another state, and because of the registration in another state, that is treated as a distinct person.
Yes.
Once it is treated as a distinct person, then Schedule 1 comes into play, and therefore any goods or services which are between distinct persons is treated as a supply. One possible argument to say that it is only in the course of my work I need to take these goods, and I'm only deploying those goods in that particular location, and they will come back, and therefore it is not supplied to that distinct person, but supplied to the location where I'm doing the work. And therefore it is not a distinct person transaction. You can try that. Otherwise, there is a cash flow impact of first time reverse payment, credit availment there. Then when they return it back, they have to charge, use the credit. It will be a meaningless outflow of transaction.
Exactly. Fair enough. So the next question is from Mr. Narendra. Recently, department is sending notices to pay interest for late filing for GSTR 3B. Can we pay the interest under protest so that if in future the government comes with amnesty scheme, we can claim refund?
You have to be careful in this, because in the amnesty scheme, sometimes there may be a line saying that the scheme is applicable only for people who have not paid. If anybody has paid, no refund shall be granted. One line might be there in the amnesty scheme. Like in the SVLDR scheme, if you remember, when the service tax settlement scheme, well, the formula, sometimes somebody would have paid more than the formula. So the scheme said that if you have paid excess, that's it, we'll keep it. So you need just 2 more days, wait for the budget and then take it as.
Yes, a great idea. Mr. Vikash Mittal is asking, can a company take ITC of services used for maintaining township, which is inhabited by its employees as well as non-employees?
When you are maintaining a township, for employees, definitely it is for your business. For non-employees, you will definitely gain goodwill. So probably somewhere throughout that area, you will have a board saying maintained by so-and-so company, or your product will be advertised there or something like that. So you will definitely get a brand mileage out of it. So if you're the moment able to get some mileage or goodwill out of the transaction, the expenditure is nothing but for the purpose of business. See, if you apply the income tax deduction 37 test, you will get the same answers.
Yeah. Mr. Venkatesh, I guess, as I am correct, in case of JDA, the developer has to pay under RCM for the landowner share. But from the discussion, I understood that that collect the GST from the landowner. Please confirm. I guess you didn't write.
There is a lot of confusion in the subject. I'll try to answer as much as possible.
Yes, sir.
In a joint development transaction, the law perceives 3 liabilities. 1, when the developer sells the 60 flats to the market, developer has to pay GST, charge the customer. When the developer hands over 40 units to the owner, law perceives that there is a service by the developer to the owner and expects you to compare the selling rate. For doing the development, the developer has got development rights coming from the landowner, which is a supply of service by itself. That attracts GST under reverse charge mechanism in the hands of the developer. So there are 3 ways it hits you. How I would look at it: development rights coming from the landowner, one can take a position that it is immovable property and not liable to GST. But if you are very conservative, you don't want any kind of disputes, then pay the GST under RCM based on when you get the completion certificate. And at that time, find out how much of units remain unsold and how much is the total units available. There is a formula prescribed. Based on that, you can discharge under RCM. 60 units to the customer, charge 5%, don't take credit. 40 units to the owner. As I said, multiple options are there. Highest option, if you want, you can adopt, or cost construction you can adopt.
Okay.
Sir, one question from Sumit Goyal.
Venkatesh, my question, I have some more doubt. Hello?
Yes, continue.
Sir, so there is no point that we are not collecting. Landowner is nowhere liable, right? Even the cases, all the cases, only the developer is liable to pay, right?
Yeah, landowner is not in the picture.
Yeah. Okay, sir. Thank you, sir.
So Sumit Goyal, if taxpayer has reversed ITC due to pressure from department and thereafter file letter of protest, nothing is happening after that, what is the suggested course of action?
See, if there is a Madras High Court judgment which says that credit is an accounting entry, and if because for some reason somebody has reversed it, they can always take a recredit. So in your case, you have reversed it under some pressure and you also lodged the letter of protest. Nothing prevents you from taking a recredit. There is also one more example. In service tax law, SENVAT credit, time limit was reduced for the first time for availment of credit. Then a question arose. I took the credit based on the invoice, reversed the credit, then subsequently I took recredit. Is recredit bound by the same time limit? Board circular said no. Recredit is only taking again what you are eligible. Therefore, if you are otherwise eligible and your protest was your reversal was not warranted, you can try taking recredit.
So another question from Mr. Vikas Mittal from most probably from Tata. Can a company take ITC of service used for maintaining township, which is inhabited by its employee as well as non-employees?
I think I've answered that.
Sir, yeah, it is answered.
Yes, you answer. Employee, you can trade.
Okay.
So surrender of tenancy right, is GST applicable, sir?
Tenancy rights have always been considered as immovable property. You have the Gasper judgment of the Supreme Court in income tax. By applying the same logic, you can say that it is not liable to tax.
Okay.
Basav Raj Kalyankar, IGST paid on import during 2021. Input tax credit may be claimed in January 22.
Problem. Because the imports, of course, the portal is now connected, but you can establish that the goods have been received, and it's only a time factor which you can always argue.
Savita Joshi, whether import needs to be reversed in case of scrap sale or only discharge of output liability on scrap sale is enough.
Scrap is goods. Okay, so there is no one-to-one correlation. So even if it is 10% of the original value, I've paid GST, and therefore there is no one-to-one correlation in GST. I bring many inputs, I bring many input services, bring many capital goods. They're all one amount as ITC credit. I have goods which are sold, I have scrap which is sold, I can set off. So there is no proportionate reversal. You can take full credit, pay the extent of GST of scrap, and utilize how much ever you want to the extent.
Again, Mr. Vikas Mittal, a company maintains hospital where its employees are treated free of cost. Can it avail ITC on the service used for maintenance and upkeep of such hospitals?
See, what is happening is that you're virtually taking care of a hospital by maintaining the hospital where your employees are given free of cost treatment. So what are you doing? You're incurring expenditure for employee welfare by taking care of the healthcare requirements of the employee. You could do it in two ways. You could ask a hospital to come to your factory and put up a outpost and ask them to provide healthcare services. Now the healthcare services by itself is outside GST. But instead, you're maintaining a hospital, and by maintaining, you're engaging contractors, etc., who will run that hospital maintenance or building or service or manpower supply or whatever. All these are required for what purpose? To keep the employee morale happy, to ensure the employee loyalty is built up, to ensure that employee is assured that the employer will take care of all his healthcare requirements, which is nothing but staff welfare. Therefore, nexus to business is very much established. But only if GST is there, you can take credit. If you're availing doctors or health professionals, they won't charge GST, and therefore there's no question of credit.
Anvesha Shetty, proportional credit reversal to the extent of flats remain unsold. Should it be covered under section 17.2 or 18.4? As 17.2 talks about affecting exempted supply under the Act, and 18.2
I got the question. I understood the question. See, first of all, completion certificate is only an event. I'm running a project. I finish the construction. I go to the local authority. He gives me completion certificate or occupancy certificate. That event is an indication that the project is complete. That's all. After the event, if I sell an apartment, it is construed as an immovable property transaction and therefore not attracting GST. Now that is a transaction which falls under Schedule 3, and because of section 17.2, it is treated as an exempt supply. But the mere event of a completion certificate does not constitute an exempt supply. So the question is whether there can be an explanation in 17.2 which can bring in a transaction as an exempt supply, which is not even a supply. So why is the government why is the law saying that you have to pay GST when an agreement is entered into and money is collected before CC? They are saying so because it is an under construction transaction. It is a service. After construction, you cannot even tax it. Once the construction is completed, it is an immovable property. Sale of immovable property can neither be sale of goods, can neither be sale of service. It's outside GST. If something is outside GST, calling it exempt supply, bringing CC as a factor, putting so many conditions, difficult. At some point, if somebody is going to challenge this and say, where is the exempt supply when I have a sale of immovable property?
Sudeep Bhagat, whether income from other source and or capital gain also to be considered for aggregate turnover, as the same does not constitute business.
They are not turnover, but they are treated as exempt supply for the purpose of Rule 42 alone.
And that is it. I don't think there are any more questions.
I have one question. Whether lift supply and installation of lift fall within the meaning of plant and machinery and hence eligible for ITC under section 19(2)(c) or D, in the case may be. And second question related to that is whether supply and installation of lift is a sale or a works contract.
You will get a lot of information when you read this Kone Elevator's judgment, larger bench
Yeah,
judgment.
I've read. True,
And
sir.
that will give tremendous amount of clarity on what it stands. And ultimately, they said it is a works contract those days when goods and labor was involved, and the definition of works contract was different. The new definition of works contract is linked to the immovable property. So the question is whether when the lift is put up, it becomes immovable property or not. It is very tricky because you can't remove the lift just like that. The entire passage has to be a tunnel. It has to have proper size and specification of concrete. It has to have a pit which has to go below the ground. It has to have adequate springs which will ensure that the lift ideally sits on it. There will be a pulley system through which from the overhead box it is able to pull that lift. The lift will be aligned with engineering skills to exactly stop at the 6th floor if you want. And if you open the gates, the 6th floor of the building and the 6th floor of the lift, the floor of the lift must be aligned. So all this would require tremendous amount of skill, engineering skill, civil engineering, mechanical engineering, electrical engineering, and the lift has to sit as part and parcel of the immovable property. If that is the case, the department is likely to take a view that the fixing of the lift into the ground is the object to ensure it doesn't move. And therefore, the object of annexation is nothing but to create an immovable property. And therefore, you may have to only rely upon safari retreats and not the definition. But if it's a temporary lift, for example, there is a political meeting and the meeting is kept at a higher level and a very senior politician is not able to climb there, they put up a temporary lift for that day and they remove it. That will be movable.
I don't think there.
So
We
if
are
someone
over to the
wants, we
questions.
can ask. If anybody wants to unmute and ask.
Yep. So, definition of plant and machinery in expansion to section 17(5) says that it is attached to earth or fixed to earth by fundamental or structural support. And that's exactly what happens in case of a lift, because entire civil structure or electrical arrangements is done by the builder.
The problem is there are a lot of judgments, not in VAT, but in excise, which have examined some of these transactions. And in the context of lift itself, there is a board circular which indicated that why it is immovable property and why it cannot be taxed.
Okay, sir. Thanks.
Hello. Sir, I want to ask two questions. Can one distinct person do job work for another distinct person and take benefit of section 143 rather than going for schedule 1?
No problem at all. There's no prohibition.
Okay, perfect. And sir, one more question is that during your presentation, you have said that if interest is paid, then tax is deemed to have been paid in time because the compensation is already paid to government. So can you give some reference of any judgment, sir, in support of this?
So I just made that when it flashed to me that why should government collect interest, but I can look at it. I have not come across a precedent directly. I can't recall directly, but the philosophy of interest is that it is compensation, and compensation is clearly indicating that you are put back to the same position.
Correct. Because what is happening, the department is earning interest in two manners. They are saying that the supplier has not paid tax in time, so he has to pay interest. You have claimed ITC earlier, so you also have to pay interest. So taking clue from what you have told, so I thought that would be a very good way to present the case.
So you can definitely build on that.
Yes, sir. Thank you so much, sir.
Sandeep ji.
Mr. Hemant, do you want to ask any question? You can unmute and ask the question. Mr. Hemant Shah. Or Mr. Manish Joshi. Mr. Hemant Shah or Mr. Manish Joshi, any questions?
Mr. Manish Joshi has
Hello.
unmuted himself. Yeah.
Yes.
Hello,
Yes.
sir, you mentioned that no reversal of input rate on slum cell. But you also mentioned the transfer of input credit to transferee. But since it is exempt service, so anyway, the transfer will not charge any GST. So then how can the transfer happen on the input credit?
Oh, he had availed all the ITCs when his business was active. And he had met the test of nexus to business when he availed the credits. Now, out of 3 businesses, he's desiring to sell one business. When he sells that one particular business, the law should have ideally kept under the 3rd schedule, but they kept it in the exempt schedule, exempt notification.
Yeah.
Merely because it is kept in the exempt notification, it does not mean that it should have a consequence of exempt supply, is one point. But the most important point is section 18, subsection 3, which provides that where there is a merger or demerger or amalgamation or transfer of business, the registered person shall be allowed to transfer the ITC remaining unutilized in the electronic credit ledger to the transferee. So the whole idea is that the ITC pertaining to the transferred business should also go to the transferee. Once that is done, then you cannot say this has become exempt turnover. Therefore, proportionately, you must also reverse your other ITC, which has got nothing to do with this business, because you already divided your books into 3 businesses and identified the ITC. And mind you, there'll be some element of common also. In fact, the rule also talks about, there's a relevant rule to 18.3, how to send ITC in a demerger. So it also talks about a formula as to how to apply for the common credits. So you can apply this much of common credit has gone to that business and transfer that. Balance will remain with the existing businesses. Otherwise, what are you doing is you're doing double things. You are identifying the ITC for the sold business and throwing it out, and then calling the sold business exempt supply and denying existing ITC also, which is not the intent of the law.
Okay.
Sir, Hemant Shah, Mr. Hemant Shah, Anvesh Shetty, please unmute and ask the question. So the question is question pertaining to ITC and landowner.
I think he has unmuted.
Unmuted.
Anveshji, please.
Yes, sir, this question is pertaining to landowner and in relation to ITC. So when we look at rule 42 sub rule 2, it talks about annual reversal, which is applicable for everybody except the real estate project. But when we talk about rule 42 sub rule 3, it talks about real estate project where reversal should happen at the end of the project. So my question is, if a landowner has ITC on construction that he has received from the builder, how should he reverse the ITC? Because he is providing 2 services. Service number 1 is TDR and service number 2 is construction. Now I'm talking about period before 1/4/2019. So because 42 sub rule 2 talks about value based reversal and 42.3 which talks about area based reversal, as my input is just one service, how do I reverse between these 2 rules?
Well, if it is prior to 1/4/19, then none of these amendments apply, no?
Sir, project got completed after 1/4/19.
You're talking about, you said something about 1/4/19. What is that point you made?
Sir, after 1/4/19, the liability to pay tax on TDR has been shifted to the builder himself. So
your
now
transactions before or after?
The TDR has happened before 1/4/19 and the construction got completed after 1/4/19.
That is a key point. See, what is a joint development agreement? A joint development agreement is a bundle of rights. This is entire land. I will dilute my ownership of entire land. I'll give you permission and license and rights to enter the property, to construct in my property, and to sell land attributable to 60 apartments, going by my same example of 40/60. So he relinquishes or reduces his ownership of land in the project. That is why he also pays capital gains as far as the land goes. So what is going from him? The right to develop. What is going from him? Possession of the land. When does all that happen? Prior to 1/4/19. Now this entire new law, 3/2019, Rule 42, Rule 43, amendments, etc.,
Zero internet again. मेरा इंटरनेट गया.
Development rents have happened through a JDA that was executed prior to 1/4/19. There is no question of any tax because 4/18 cannot be applied, 6/19 also cannot be applied. And both these notifications cannot be applied to a transaction which takes place prior to that. That would be a much easier approach to the issue.
Thank you, sir.
So CA Pooja Advani, I think it has been replied.
Yeah.
Whether Himansha, whether RCM is applicable to trust. Second, is it a business entity and thereafter claim ITC?
Trust is, it again depends on how you would interpret the word body corporate. Some of the RCM definitions uses the word body corporate. Some of them refer to specific parties. So if the word body corporate is used, the body corporate has the same meaning as available under the Companies Act. And if on interpretation of the definition of body corporate under the Companies Act, there are some judgments in Companies Act where you can say the trust is not covered as a body corporate. So if it is not covered, then there is no question of RCM at all.
So Ashish Mashkara, there are many services and goods which are used even after obtaining completion certificate. Can we claim ITC?
The problem is this completion certificate is issued before completion itself. So the local authorities will issue the completion certificate merely if a shell is in place. And then there's a whole lot of work that has to be done. So I would put it like this. If you have customers who have booked before CC, then whatever monies you receive from them after CC remain taxable. But after CC, if you are having customers who are booking for the first time, whatever you receive from them is not at all taxable. So if you have some customers who have already booked, then proportionate at least you can take because the service has to continuously be provided to them and for which there is a GST element which is payable and therefore credit is also available. But if all your customers are coming only after a CC, then no credits. Again, I repeat, no credits in the sense you can't use it. One can test it by saying, where is the section which says I cannot take goods credit or service credit because I'm using it for a non-taxable transaction? There is no provision. See, go back to Senvat Credit Rules. Rule 6.1 very clearly said that no ITC can be availed in respect of inputs or input services exclusively used for an exempt supply or a non-taxable supply. That is missing in 17.1 and 17.2. Formula might come. But the point that I'm trying to make is, you may be eligible to take the credit because it is used for business, but you may not be able to set off because there is no output liability. Assuming you have multiple projects and some other project revenues have GST liability, you can try testing it, but 100% you will get into litigation, which has to be tested based on the fact that provision similar to Rule 6.1 was not available.
I think we are over with the questions.
Yes.
Can I ask a question, Venkatesh?
Yes. Yes.
Sir, suppose, can department disagree or question if I claim refund of the cash ledger? Can they put any conditions for that? Because by mistake I paid something. Without any condition they can give, right?
Cash ledger is your money, sir. It's like your bank.
Yeah, but there is a situation. I'll explain the situation. I've imported the goods from the foreign country, so I should have paid the import duty. IGST I should pay, but by somehow I did not pay the amount. I could get the goods, but suddenly I returned the goods back to that country. For discharging that liability, I paid some money into cash ledger, but somehow I did not pay it, so it is lying in my cash ledger itself. When I'm asking refund of that cash ledger amount, department is questioning so many. They're asking so many questions. They're not returning the amount. They're asking us to prove why you paid unnecessarily. If there is no liability, why should you pay something? They're asking a lot many questions.
Theoretically, they may have a suspicion, but they have no right to hold back cash ledger refunds. It's a very important refund. You escalate it to some other higher authority, you should be able to see the refund.
How can we go like that, sir? I mean, saying that the suppose the GST officer, only concerned GST officer we can go. If you are saying that you go to higher authority,
if the amount is huge and you really feel worried about it, you must escalate to the higher authority who will understand your situation much better. Please understand, cash ledger is nothing but the PLA, original days of excise. PLA balance now was automatically refundable.
Okay.
Like bank, it's a bank you're putting in advance.
Vikas Kumar has raised his hand. Vikas
Yeah,
Kumar,
good evening,
sir.
So will this be
I have one question. I am getting 1 crore rupees of value in my property in view of leaving my fiancé right. How to raise bill or whether the bill will be having GST or not, sir? But on compensation, GST is to be charged. So if I will be getting immovable property worth 1 crore rupees compensation as leaving my fiancé right, how I will be raising?
I could not hear him clearly, but I assume that he's asking a question whether compensation attracts GST.
Sir, it is clear compensation attracts GST, but I want to know that if I will be getting immovable property worth 1 crore rupees, how to raise bill for this? And shall I be charging GST on that consideration of 1 crore rupees?
Compensation is not consideration. Therefore, there is no supply of goods or supply of services. There is no question of GST on compensation. If there is no GST, then it is not a taxable supply or an exempt supply. Mere whatever document you raise is enough. Even agreement is enough.
Okay, sir. Thank you.
Fine, sir. I think we can wind up. We have covered extensively.
Yes,
Right,
sir.
Yes, sir. Yes. Sir.
Yes, sir.
Sir, very extensively covered.
कमल सर को अनम्यूट करो. कमल जी
कमल।
अनम्यूट करिए.
हाँ.
Over to you, sir.
Barka is there?
Yes, yes, sir.
Please give the formal vote of thanks.
Thank you, Chairman, sir. I thank on behalf of ADPA and today's participant, Speaker K Vaitheeswaran for sparing his valuable time and sharing insights on controversies related to input tax credits in GST. I am confident that this deliberation has benefited the participants immensely. Thank you so much, sir. I also thank our participants for today who is here with us and hearing listening the deliberation so patiently. Thank you all.
Thank you very much.
Thank you so much, sir.
Today's session
Thank
we
you, sir.
had lots
Thank
of
you very much.
questions. This is a particular, sir. We have not seen so much question in any such GST seminar which we have faced today. And all the query was answered, sir. Thank you very much, sir.
Thank you, sir. Thank you. Good day to you. Thank you. Good
We
evening.
will look forward for some more seminar with you, sir. In
Most welcome.
coming months, sir.
Anytime, sir. Thank you. And I hope all this COVID goes so you can make a visit to Calcutta.
Definitely,
Sure,
sir.
sir.
That is what we are
It will be
waiting
our
for, sir.
pleasure.
Okay, sir.
Sure,
Thank you.
certainly, sir. Certainly, sir.
Thank you, sir. Thank you so much.
Thank you, sir. Good night, sir.
Thank you. Bye.
Thank you.
I'll leave.
Thank you. Thank you.
Thank you, sir. Thank you very much.